Good morning, Houston Industrial. I hope it's like 900 degrees there today and all of the cold is melting. I'm coming to you. It's Todd Phillips. I am our webinar host coming to you from Minneapolis, Minnesota. And it's always cold here and we're used to pipes freezing and stuff and we take care of that. But I was sorry to hear that y'all had to go through that and hopefully it's clearing up fast. This is us, Houston Industrial Logistics Summit. We're Red News. We have a bigger company called RE Journals. Red News joined our into the fold a year and a half ago. And ever since we've been ramping up our activity in Houston, Dallas, San Antonio, Austin, helping you get news and information out in Texas as best we can, even in the cold. So special thanks to these sponsors who are helping us spread the good word, Sparrowhawk, CenterPoint, and Houston Gulf Coast CCIM chapter. We always love our partners when it's CCIM or SIOR or anybody like that. So thank you to you all for helping us out, and we're happy to help you out in return. Again, this is us, RE Journals. We have 6 publications in 17 states across the Midwest and Texas. Chat, that's where you want to ask questions of this group. So we don't use the poll function or anything like that at Fancy in our Zoom. We just use the chat function. So open that chat box. This is a good chance to say hello to everybody else that's online right now. Say, hey, I'm here. I'm Joe. I work downtown, and whatever you want to put in there, whatever part you play in the industrial real estate world, feel free to say hello. But that's also where you're going to ask questions of our panelists. So our moderators will keep track of that chat room. I'll keep track of it. We'll make sure your questions get answered. This event is approved for 3 hours continuing education credit. So if you're one of those people, in some states, I know we got to do this, ask a poll question, do all this crazy stuff. Texas, you're lucky, business-friendly state. I love it. All you got to do is make sure you log in on time and log out on time, because we take those timestamps, send them off to the TREC, make sure you get your credit. I'm going to step away. Rives, I'll be here if you need me. If you have any questions, just say, hey, Todd, I'll still be listening and pay attention, but you won't see my picture or hear me. I'm going to turn over, let you guys do that. I'll let you do intros, and I'll be back in an hour to let you know when you got a couple minutes left. Thanks, everybody.
Great. Thanks, Todd. So welcome, everyone. Thank you for attending today's event. We have a great lineup of industrial real estate topics and Houston industrial real estate veteran experts for you today. So I'm excited to be here. We'll start with introductions. I am Rives Nolen with CenterPoint Properties, and I lead our Central Region Investments team. CenterPoint is in 12 markets across the country, and we own, develop, and invest in industrial real estate. We own about 6 million square feet in the Houston market, and we're currently looking to expand into Dallas, Austin, and San Antonio, as well as grow our Houston portfolio. And with that, I will turn it over to Jeff. Jeff, would you introduce yourself to the group, please?
Yeah, you bet. Yeah, thanks, Reeves. Jeff Venghaus. I lead our at JLL. I lead our 16 team members that all obviously specialize in industrial with a cross section of tenant representation and agency project leasing work. So we're excited I'm excited to represent our team here this morning, and look forward to sharing hopefully some good insight.
Excellent. Thanks, Jeff. Justin, would you introduce yourself, please?
Yeah, absolutely. Good morning, everyone. And thank you, Red News, for the opportunity to speak on the panel this morning. Appreciate the invite. I'm Justin Robinson. I'm Managing Director and Partner of Stream Houston office. I oversee our transactions business. I work closely with Madison Hamilton and Tyler Maynor on the industrial team, and Ryan Barbold on the office team. We lease and manage about 50 million square feet of office and industrial product here locally. My background is industrial, passionate about the industrial business, very much a player coach is how I would describe myself. So very active day-to-day in the leasing and development of our Stream Houston office. And then, so I work in the business in that regard, and then work on the business in terms of strategy, hiring, talent identification, et cetera. So excited to be here.
Excellent. Thanks, Justin. And so as many of you know, Jeff and Justin are industry leaders in industrial. I've had the pleasure of working with them quite a bit over the years. And so I'm really excited to get their thoughts on some of the topics that we've got to cover this morning. So let's jump into it with kind of a market update to get started, and just cover kind of what's happening in the market today in terms of vacancy and availability rates, absorption, new construction. There's a lot of talk about supply and whether we've developed too much and, we've kind of too much supply. And so what issues might that be causing in the marketplace in terms of, additional concessions? How is the market responding to this? And let's go to Justin, if you'll take the lead on that one, and then we'll go to Jeff for any additional comments.
Sure, appreciate that. Yeah, I mean, we're getting a ton of questions along this same vein. A lot of it recently has stemmed from the Wall Street Journal article citing Houston as a oversupplied market with a lot of concerns about our market here locally. And we continue to be one of the most misunderstood industrial markets, I think, in the country. What you really have to understand about Houston's industrial market, if you pull a CoStar report, it'll tell you that we're a 600 million square foot market, and that's true. The way that Stream looks at the market is a little bit differently, and we break it down into what we classify as the institutional quality assets, which represents about 320 million square feet of that 600, and then the rest of the market is what we would say is more specialized, crane serve, metal, buildings that are really more closely tied and closely correlated with the upstream energy business. And so really within Houston, we have two different markets that really operate almost mutually exclusive from one another, meaning that the upstream energy business has very little impact on the 320 million square feet of institutional quality assets, and it has much more of an impact on the metal crane serve side. So from an institutional market, one thing that Wall Street Journal article left out, it was very much supply side focused, and there were some quotes in there from several quarters ago from different earnings calls, but it didn't really mirror what we're seeing on the ground in terms of activity on the demand side. And so I think what's happened is there's certainly been a lot of new supply, and if you look back really since 2016, we've had over 40 million square feet of new development in our market. And so, that's a massive increase on a 320 million square foot base. And then in 2020 alone, we had over 16 million square feet of new delivery. So there certainly has been a lot of new supply. And last year, we had a very strong first quarter. Obviously, second and third quarters were very, very slow, pandemic related. Couple that with the election. So anytime there's uncertainty, people tend to just hunker down and not do anything. It just creates paralysis. And so we had a very strong first quarter, very strong fourth quarter. We did as a leasing team, we did over 200 transactions last year, and that was pretty evenly weighted between new deals and renewals. And that was actually an all-time high for our Stream industrial team. So, what was perceived as a bad year, was actually very active, and it was very heavily weighted the first part of the year and the last part of the year. And then looking forward, and I think this, from discussions I've had with Jeff and others, I think this is pretty consistent with other major shops around town, but we have about 18 million square feet of prospects on our deals in the market list. And that represents about 100 tenants in the market. And that excludes a lot of the most active, massive e-commerce groups that have a lot of requirements in the market. These are ones that we've identified and have actually honed in on a specific submarket. So, overall, we're very bullish on the market. On the institutional side, I can't really speak to the manufacturing metal crane serve side of the market, but we're very bullish overall.
Okay, great. That's good to hear, Justin. Thank you. Jeff, anything that you want to comment on there or just kind of add to that in terms of what you're seeing?
I certainly concur. And in fact, we were talking last week about that number of how many tenants are in the market, and specifically the square footage. And it's about 18 million, which is encouraging. Hey, and I do want to give a shout out to our colleague, John Ferruzzo, who we're missing this morning. John,
Yeah.
if you're listening on a recording at some point, he's had some difficulties at his house with the freeze, and we're going to miss him this morning. We've been texting with him, and he's, I know a lot of people around the city are going through a tough time right now. So our hearts go out to them, pray for them. You know, one thing along those lines that I just kept thinking about over the last few days, post this freeze and weather challenges, is how Houston is very resilient. And maybe that feeds into our conversation today, maybe slightly off topic or agenda here, but you know, when we talk about the demand and we talk about the supply, you know, there's this question mark, and Justin touched on the Wall Street Journal article, which a lot of us got, you know, maybe emails about or calls about, and how do we address that? The demand seems to be there for obvious reasons: e-commerce, residential home building. You know, Lowe's and Home Depot had record years. So those are two trends that, you know, are growth sectors that we're continuing to experience. But I just couldn't help but think about and maybe want to talk about just the resiliency of Houston, really the state of Texas. And I think that's attractive when you talk about demand in Houston, because it's related to the demand in Houston because people want to live here. It's hot in the summer, but you know, our population is growing, and there are, you know, corporate companies moving here. So as we talked this morning, and as perhaps as the panels take place later on this morning with different topics, I just believe in Houston. I think everybody on this panel probably does. We appreciate this industrial market, and we're optimistic about it. So yeah, where there's a lot of supply, we'd like to think that you know, it may take a little time to get everything absorbed, but you know, post-pandemic, or while we're still kind of operating in a pandemic a little bit, but we feel like we're a little bit past it with the vaccine. Perhaps, you know, there'll be some more consistency this year, because really last year it feels like, based on what Justin just conveyed, I mean, we had like 2 quarters of business, maybe 2.5, and a lot of us still had really good years, which was very interesting. So I'm remaining optimistic, and I think a lot of us on this call are.
Yeah, and just to add to that, you know, when I talk about the institutional market, and Jeff just touched on it, spurred another thought, but really what drives our market is consumptive demand, and it's the 7 million people in our MSA. So it's things that you need to live, work, play, and eat, right? That's really what drives our market. And so in any given year, 7 million people are not going anywhere. So that continues to fuel our market. And then when you couple that with the compressed timelines that the e-commerce phenomenon is presenting, just, you know, where 2-day delivery used to be the status quo, or at least free 2-day delivery, now people order online and expect those products same day. And so, you know, those two things coupled together really believe that are going to continue to fuel our industrial market. And, you know, another important topic to note, when you talk about new supply, that's only touching on the Class A segment of the market. There's a thriving Class B market in Houston that's completely unaffected by what's going on new supply related, because a lot of those projects are located where you can't build new product today. They're demised smaller than what a lot of the new product can demise to. And so that doesn't get a lot of headlines because it's not the sexiest topic in the world, but I know our guys that are working on that Class B stuff, like Jeff said, they had record years last year, and it's a little bit under the radar, but that's a big driver in our market. So I just want to make sure we touch on that, because it's an important topic.
Yeah, thanks for bringing that up, Justin. That's a great point, and let's actually dive into that a little bit more. You know, we were for a while, we were hearing a little bit about flight to quality because of all of the new supply, and so it's interesting that you bring that up. That, you know, it sounds like what you're saying is it's almost kind of 2 different segments of the market, and so while you may have some flight to quality happening, it maybe doesn't affect the market too dramatically. Is that right? And if so, would you anticipate seeing better rent growth in the Class B segment of the market in the near term?
I can take that, Justin.
Yeah. Go ahead,
I think you made a good point, and I'll just kind of jump in on that. But yeah, the Class B, it's interesting. to Justin's point, it's well located. A lot of it's sort of infill. In many cases, as many of us know on this call, Houston can be a very local regional market. So you have local companies who are very good quality businesses that need to be well located. Okay. And it might be in a Class B type facility, but 22 or 24 foot clear is sufficient for some of these groups. And sometimes these, we'll call it front load dock high distribution buildings, if it's a couple 100,000 square feet, but it's chopped up in 20, 30,000 square foot spaces. Those things lease very well. They always have. In my 21 years, They always have moved pretty well. And then the rates for those buildings tend to just kind of follow new construction rates. It's not going to be a big gap. They're going to kind of follow. I could use an example over at Pine Timbers. We always kind of joke about Pine Timbers in our office because kind of the smaller users, seems like that project's been around forever. It stays well leased, and it's Class B. It's probably what we call infill at this point. But I've got a couple clients in there, a lot of local regional users, and rates in that building I never would have thought are in, call it the low 40s net range. I used to lease that building for 29 gross. So very interesting. And I think it kind of leads into what we're going to talk about today. And again, perhaps later on is location, infill, close to town. This whole urban infill conversation that's going on a national basis. That's just a trend that we're really starting to see to support the population growth that, is interior, but that's going out. You just can't replace location. And Justin mentioned earlier, you can't build new buildings on where buildings already exist, right? Or small land sites that are quote unquote infill. So these well-located Class B infill buildings, I think, are sort of standing the test of time, which is amazing.
Yeah, no, I totally agree. And we oftentimes, it's counterintuitive, but we're seeing Class B rent exceed Class A rents in a lot of instances. And it's just because of the divisibility factor and the location factor. It's once again, it's not necessarily competitive with that new product. And so, Rives, to answer the second part of your question, we do believe there's a strong rent growth story for that well-located Class B product. And a lot of tenants will put up with the functional challenges that those buildings have, with lower clear height, shallower truck courts, et cetera, in exchange for that proximity. And really what drives our market, once again, is that consumptive demand. And Jeff touched on it perfectly a minute ago, but when you're serving a local population, your main concern is lowering your transportation costs. And the way that you lower your transportation costs is to locate your facilities as close to that population as possible. And we commissioned a study about a year ago where we looked at where is the true population center of Houston. And so we ran a GIS model, had a company do it for us, and they identified, as of 2020, the population center of Houston is effectively at the intersection of 610 and 290. And so if you look at our market, the Northwest submarket, of the 320 million square feet that we classify as the institutional side of the market, 100 million square feet of that is in Northwest Houston. And so why is that? Well, the population center of Houston, which means it's the mean population center, which means an equal number of people live northwest, east, and south of that point. And so if you're trying to lower transportation costs, you're going to try to get as close to that point on the map as possible. And so that's really what's fueling that Northwest submarket to continue to be as resilient as it's been, and continues to be our largest, and most active in many instances submarket in town. And just looking at the overall expense stack of running a distribution center, transportation costs oftentimes are 40 to 50% of the cost of running a DC, while rent is 4 to 5%. And so people theoretically, order of magnitude, it's better, it makes more sense to locate closer to that population center to lower transportation costs, even if you have to pay more in rent. In the grand expense stack, you're going to come out ahead. So we continue to see that drive, not only Northwest Houston, but really the whole west side of town. And that's a big reason why people are often confused why Northwest is a third of our overall inventory. And that's really why and what drives that.
Yeah, it makes sense. I think that's a good segue into our next topic. And if there's time, we may circle back to that topic and continue there. I think there's so much to cover there, but let's move on to tenant needs and kind of talk about what are the needs of tenants that we're seeing in the market today. How are they different than in past years, or are there some new trends that are emerging and things that are different, or is it different segments of the market? And then, if the needs of tenants are changing, how are developers and landlords responding to meet the needs of those tenants? Did we lose Jeff? It looks like we may be having a Jeff, are you still there?
I don't see him in the list. I know he was doing Wi-Fi instead of being plugged in, so I assume he's in the background getting ready. I've got my tech team trying to track him down. There he goes.
Oh, there he is.
I was going to go to Jeff on this one first if he's there, but
Well, I'll kick us off, Reeves, and then Jeff can chime in whenever he gets back online. But one thing we're seeing a lot of is speed to market, and so we're seeing that on groups that are looking at existing product, and we're seeing that people that are looking for build-to-suits as well. So it's more important than ever, and this is pretty much across the board in every major submarket. But having spaces that are ready to go, that are spec office, that are white box, that have LED lights, that have a certificate of occupancy or the equivalent in whatever municipality that you're in, we're seeing that become more and more important. And it seems like every week we're adding deals onto our deals in the market list that have very quick fuses. And I don't know if that's related to the uncertainty that 2020 presented, and there was a lot of pent-up demand that's now kind of behind the eight ball, so to speak, on needing to open a new facility. But we're seeing that time and time again, that people are they need to be in the market, and it needs to happen quickly. And so those spaces that have that infrastructure in place and kind of plug and play seem to be winning more often than not. And then on the ground up side, for example, out at our Empire West Business Park out in Brookshire in West Houston, we went as far on our vacant land sites to go ahead and make pad ready sites. So we have a 1.2 million square foot pad, a 600,000 square foot pad, and a 700,000 square foot pad, in addition to our first phase, which is our spec phase of about 1 million square feet. So in the spec phase, we've got spec office lights. So somebody, as soon as those buildings are done, could literally within a week go down to the city, apply for a name change on the certificate of occupancy, and be up and running, or really as fast as a lease could be signed. And then on the ground up side, once again, we have those pad sites that are ready to go. And that shaves off about a month of the overall timeline for the actual dirt work and all of that to form that pad. And then on the infrastructure side at that development, we have all of the water in place, all of the wastewater solved, drainage is in, storm water's in. So it's truly plug and play from a utility standpoint. So all of those things we did and spent that money on the front end, and detention, those sites will be net of detention as well. And so all of that is to just compress that timeline, that instead of a 12 to 13 month process, let's try to make it 10 to 11 months, because that 1 or 2 month difference can be the difference in making a deal or losing it to a competitor. So we're trying to find creative ways to just compress the timeline, whether it's on existing product or new development.
Yeah, that makes sense, Justin. Anything that you're seeing in terms of from a tenant need perspective that you're incorporating into the design on your buildings as you're developing out there, or any of your other projects?
I mean, it's some more of your kind of standard stuff. Obviously, we're seeing parking, increased parking ratios being increasingly important. A lot of that's being driven by the e-commerce phenomenon. And so on all of our projects, we're trying to leave room for either expansion of parking or trailer storage, outside storage, or all of the above. We're trying to leave that flexibility. You're starting to see, obviously clear heights are increasing, where in Houston traditionally, and still in a lot of instances, you can get away with a 24-foot clear building. The national capital markets are now pretty much demanding that you be 32, and that's going to 36, and that 36 is going to 40-foot clear. And one of our buildings at Empire, we went 40 clear for the first time. So we'll see how that benefits us there. But yeah, parking, outside storage, trailer parking, increased clear heights, and speed to market are the things that we're seeing be the kind of common denominator of most tenants right now.
Yeah, and is there an increase in trailer parking too, or is it just auto parking primarily in the Houston market?
No, it's both. It's both,
Yeah.
depending on the tenant, and really depending on the submarket. Down by the port, trailer storage, outside storage is going to be more important. And then in other markets, it may be auto parking. So it's kind of submarket or user specific, but we're seeing both.
Great. Jeff, are you back online? Jeff, you there?
It's
Okay.
not like there's weird things going on in Houston right now with power and water. I mean, things are totally normal, Jeff. What's going on?
Yeah. Okay. So it looks like we're having some technical difficulties.
Reeves, we've got this, Reeves. We've got
You
this.
guys can do it.
Yeah.
I believe it. Let me know if you need moral support. I'll be here.
Yeah. No worries. Thanks, Todd. Well, let's keep moving, and then we may circle back if we have more time and dive into this a little bit more. But the next topic on the agenda is submarket discussion, and in this one, we really want to. There he is. See if he gets connected here. And
hey, I'm back. Sorry about that.
All right, Jeff. Yeah, no worries, man. Glad you're back.
I'm not sure how I got kicked off.
Yeah. We were just talking about the tenant needs in the marketplace, and kind of what you're seeing from tenants and how developers, landlords are responding to this. And Justin kind of went through what they're seeing over at Stream in their business, but with you, working directly with a lot of tenants and users, what are your thoughts on this? And are there things that you're seeing that are evolving in terms of what the tenants are looking for in their facility requirements?
Yeah, and I hope I'm not repeating what's already been mentioned. Sorry about that. I think our Wi-Fi just totally kicked off, so I'm on my iPhone now. And I think this has been mentioned in previous panels, but clear height requirements are a big deal now in terms of probably being a 36-foot clear or higher, 36 kind of being the standard. Great circulation around the building, tractor trailer storage capabilities. Obviously, industrial real estate 101 would tell you that ingress egress is very important. So where it might not be visibility, it's quick access to freeways. We're seeing from the likes of Amazon that even just vehicular parking or van parking is a really, really big deal. So industrial sites have to have good coverage ratios, of course, but they just have to be a little bit bigger to accommodate. And I can also mention that, we'll see how this trend evolves with regard to, office space demand, or right now maybe a little bit lack thereof. Perhaps we'll see some consolidations happen where companies will move from office space or as much office space into an industrial building, whereby you'll have a need for a lot of parking and a lot of office space. A deal last year that I was a part of, it was a couple 100,000 square feet, but they needed 40,000 square feet of office, which is, in some ways, and it's not a big, huge headquarter, global company per se. It was just a consolidation of sorts, but they wanted to get out of their office space and have everybody, consolidated at one location, which is an industrial building, which can be cheaper for office space. So those are, kind of a smattering of trends we're seeing. As we see location dynamics occur, such as, well, there's not much land, as we all know on this call, perhaps, that good quality industrial land is hard to come by, right? So it's becoming further and further out. But as you go further and further out, you must be close to some, high quality thoroughfares.
Yeah, it makes sense. Okay, great comments, Jeff. Thank you. So let's shift over to the next topic, which is the submarket discussion. And what we really kind of want to look at here is, with all the new development that's happening and kind of the new trends that are emerging in the market in terms of on the tenant side, on the demand side, are some submarkets performing better as we've seen in previous cycles? And which ones are performing the best and why? Justin, you want to take that one first?
Yeah, I mean, from what we're seeing, that really it's two areas, and one area encompasses multiple submarkets. Really the western side of town, so the southwest submarket, the west submarket, which we just broke out in our statistics a couple quarters ago to be its own standalone market, and northwest Houston. I think a lot of that ties into the consumptive demand story that I told earlier, and trying to be as close to that population center at 610 and 290 as possible. All three of those submarkets, southwest, west, and northwest, really offer comparable access back to that point. And then from a west submarket standpoint, we're seeing a phenomenon where you can still serve that local population story very well from that location, but you can also serve a regional basis. So within a 5-hour drive, you can reach about 15 million people from West Houston. And so we're seeing that really emerge as a kind of a combo market where you still have your bread and butter Houston tenants, which are the consumptive demand-based tenants for our local market. And then that's also coupled with the regional reach of West Houston, which can serve Austin, San Antonio, and the Valley, and the 15 million people, including Houston, from that location. And then secondly, we're continuing to see the port be very active. There's been a lot of new development down there the last several years, but that space is getting pretty well absorbed. And you're just seeing more and more barriers to entry to that market from a development standpoint. And so we think the port market is in for a really good run over the next couple of years, with the biggest, most quality land sites in what we classify the infill side of that market, which is really south of the ship channel. It's hard to find a large developable site at this point. I mean, you could kind of point at anywhere on the aerial and you could find a 100-acre site that was $3 a foot, and it made sense for industrial development all day long. That's just not the case anymore. Those sites have either been put into production, or with the new floodplain regulations that Harris County and some of the surrounding municipalities have instituted, it's making a lot of those sites undevelopable from an industrial standpoint. It will cost too much and take too long to bring those sites up and out of the floodplain. By the time that you put in detention, you mitigate for that floodplain, and you bring in fill to get the finished floors up and out of that area, it doesn't pencil out. So most of the new development in that submarket is moving north and east over to Chambers County, which you predominantly have two large landowners over there that are kind of releasing land sites at a measured pace. They don't want a ton of spec development necessarily in their parks until some of that existing product stabilizes. So you've got, for the first time down there, you've really got some pretty high barriers to entry, and people are having to get creative to develop. And so overall development is slowing way down. We think on the infill side of the market down there, you're going to see some pretty good rent growth over the next couple of years. And so there's a really good story down there. And the port itself, what's interesting in looking back, over the last 10 years, that port submarket has doubled in size. It's gone from just over 20 million square feet 10 years ago to over 45 million square feet today. And 10 years ago, if you look back, it was pretty rough down there in that submarket at that time. Mm-hmm. And it was really, up until 2007, we only had one container terminal that was operational. That was the Barber's Cut terminal. In 07, we had Bayport added, which effectively doubled the capacity of the container traffic in and out of the port. And then along with that, with the decrease in energy prices, we've seen a real boon to that submarket in terms of the exports and the feedstock being cheaper to go produce all of those plastic resins. And so if you look at the port stats, I mean, it's very balanced from an import and export standpoint. And so that's really, really driven that market. Whereas 10 years ago, you were dependent on a new tenant to the market. There just weren't enough tenants that were there and expanding and moving around. So you needed net new growth to really drive that market. And for the first time now, we're starting to see tenants down there expand, relocate. So you actually have a very, very viable market. So we like West Houston and the port. And then North Houston continues to struggle, has the highest vacancy rate that we track at 14.3%. That's really just self-inflicted wounds from overbuilding in that submarket. But there's some good deals working up there that are on our list that we think will transact over the next quarter or so that could move the meter pretty significantly up there. So you just right now you can't paint Houston with a really broad brush. You have to dig in on a submarket specific level, and then even within the submarket on a micro market level, and really look at within those micro markets, Class A, Class B, and the different drivers. So it's a unique time out there for sure.
Okay, great commentary. Jeff, what are you seeing out there in terms of submarkets? Which ones are performing better than others? And you're coming at it kind of from the user side again. So interested to see how how your comments compare with what Justin's seeing.
Yeah, I think Justin covered it very well. East and Northwest, are probably the most attractive. I will say this about Southwest, and Justin knows this, and because they have some product down there that they're leasing and developed. But Southwest Houston has really emerged over the last number of years, which has been interesting. Kind of going back to my comment about ingress, egress, and good thoroughfares being, down there, 59 and Beltway-ish. I think that's the key when we're talking about, developments moving out further. We've got detention requirement issues that are prevalent now. For you guys that are developers, you're knee deep in that. But as you go further out, you're going to have to be, again, I'll repeat myself, close to a quality thoroughfare. But yeah, East has continued to do well. I remember back, number of years ago, East Houston rates were considerably lower than the rest of the market, perhaps, and that's just not the case anymore. So tenants are very, but they have to be there. A lot of them have to be in that East Houston sector. But yeah, going back to the lower gas prices, we saw great growth down there in the plastics packaging business and the exports. Yeah, North Houston, I think we'll start seeing some more deals up there and more opportunity because there's, again, a considerable amount of supply. I think Justin mentioned 14%. So landlords will probably have to get pretty aggressive to knock down some deals up in that sector. So, but overall, it's exactly the truth that each submarket has its own personality and own dynamics. JLL will have brokers from around the country come to me and ask for help on a transaction in Houston, and they'll say, "Hey, we want to be in Houston. We need 50,000 square feet." And my first response to that is, "Where in the world do you want to be?" Because the city is massive, and we have 4 or 5 different submarkets with different personalities.
Right. Yeah. No. Good comments there, Jeff. And I'm just curious, and maybe kind of tying this, kind of ask each of you to comment on this, but sort of tying this submarket discussion back to kind of the market update. What are you seeing in terms of market rents in these submarkets that are performing better? And in for example, the North market, what kind of differences are we seeing the impact of free rent and other concessions, or are rates lower, and kind of what are the differences that we're seeing, just in terms of kind of a lease economics perspective in these different submarkets?
Yeah, I can take that. I know since I dropped off, Justin probably shared a lot, so I'll try to pick up some of the pieces. But yeah, in that North Market, I mean, I think you're going to see probably the most aggressive deals up there, where rates, could fall just a little bit. But overall, in Houston, I think rates are they're I would say holding, where tenants do take advantage of opportunities as concessions, right? Especially these new shell buildings, TI and free rent. We're seeing that on a pretty considerable level. Houston, in some ways, I mean, I think it's trying to get there, but different than the Inland Empire or New York and New Jersey, or maybe Atlanta, Chicago, you're not seeing rents grow as much as those other markets. Call it, the ability to develop new, there's not as many barriers to entry per se. There's a lot of land. We don't have mountains and too many oceans to keep us from building. So the supply tends to be there. But I tell you, over the last number of years, because of consumer goods and e-commerce, as mentioned earlier, back to the Class B product conversation, rents, have gone up, but in some ways, it's probably not as high as some institutional investors, might desire. But that said, I think there's good stability, there's good consistency, there's good quality users. And so I don't think we're going to see a fallout at all. But where you will see some softness, again, I'll repeat myself, is up in kind of that North Market due to the vacancy.
Yeah, makes sense. Okay. Justin, anything to add?
No, I think Jeff covered it well. One other thing to just point out when you're looking at really what drives that kind of northwest, west, southwest side of town is very strong labor. And so that's another thing that we keep hearing from users, especially on the e-commerce side. That's the first thing that they're underwriting is the labor study. And so all of those areas are very, very strong in regards to labor. So that's just another thing that's driving people to those areas as well. So wanted to add that, because we're hearing that, on every major deal, we're hearing that as a topic of concern. And it's one of the first things that groups are looking at, first box they check, and then they dig into the real estate from there.
Yeah, that's a great point, Justin. And I think it's really, sorry, Rives, I think it's really great that you brought that up, because then we have the Amazon factor. We can't help but talk about them, right? When you're talking industrial real estate, I mean, they absorbed, a little over half of the space nationally, industrial space. So you have to talk about them, right? But yeah, in terms of their labor, that's something else that tenants are seeing and kind of competing with, if you will, is the labor that Amazon attracts, and having to kind of compete with that. That's a big deal. So you got to be well located to attract good labor, where there's a good density of that availability.
Yep.
Yeah, it makes sense. And Justin, I'm just curious, when you're talking about the west side, are you specifically talking about out in Katy, or are you also including kind of northwest and southwest submarkets?
Yeah. In that instance, when I'm talking about west, I'm really talking about 249 down to call it 288. So like the entire western side of Houston offers there's nuances, right? You go out too far on 290, you hit kind of a diminishing labor pool. You get too far out, you're not gonna have the right metrics. But generally speaking, that west side of town, and it makes sense, right? If you just look at how Houston's growing, it's north and west, and that population center that I keep talking about at 610 and 290, that's every year that's moving further and further out. 290. I mean, we're landlocked to the east, right, with Galveston Bay, and so you've got Spring, the Woodlands, Tomball, and then all of the western growth. And so very, very strong labor really in the entire western half of the city. And then it's more nuanced than that, but generally speaking, it's pretty good.
Before we go on to the next topic, do you guys have, I think you both made comments about how last year, despite COVID and, the obvious impact that it had on the market, we kind of had, a quarter or two where the activity was terrible, frankly, right? I mean, we were all dealing with that, but somehow, by the end of the year, we managed to end up with pretty good numbers, right? The absorption numbers and based on what you're saying about the deals that you're tracking in the market at somewhere around 18 million feet, it sounds like both of you are optimistic, and I would say that's consistent with what I hear, talking to people. There seems to be a lot of optimism that we're going to kind of continue into 21, that trend of some pent up demand and kind of starting to absorb a lot of this excess supply of new product. But any kind of thoughts, or it won't hold you to it here, but do you have a kind of a forecast or an educated guess maybe on what do you think will exceed last year's numbers in terms of absorption, or any other comments on that topic?
Yeah, I'll take it. I mean,
I'm putting you guys on the spot here, so
Yeah.
sorry about that.
No, it's a great question. I think that we will, in terms of overall absorption, I think we'll have a much better year this year than we did last year. Just, really 18 to 20 million square feet is kind of an all-time high in terms of our deals in the market list. So that feels good. And then just what we're seeing on the ground that hasn't made it into the statistics. Like there is a lot of leasing activity in the market right now, and it just hasn't shown up in the numbers, and it will. So I think by the end of the year, fourth quarter 2020, to back up a little bit, we were tracking the market at 9.5% vacant, and I would venture to say that we'll be somewhere in that upper 7 range by the end of the year. So I think there'll be a massive amount of absorption. And one other thing that we haven't talked about is just the increasing size of the deals in Houston. I mean, there's double-digit number of 500,000 square foot plus deals in the market right now. And so, who knows how many of those will actually happen, but if half of those happen, that's a significant amount of absorption in and of itself. And then when you layer in the more bread and butter Houston demand, which is 30 to 150,000 square feet traditionally, then and we're seeing that demand play out right now in buildings across the city. We just feel like it's going to be a great year, and time will tell, but that's our best guess.
Hey,
Yeah.
Justin, I'm glad you brought that up about size. I wasn't sure if y'all mentioned that earlier, but that is absolutely the case. I mean, Houston on average 10 years ago, our average size deal was what, 50 to 60,000 square feet,
Yeah.
maybe even smaller. I tell you, we've kind of matured, right, as a city, maybe not viewed as completely local market or local regional. It has some national implications with a lot of large retailers here. I think that's a needle mover sort of thing, and a good trend to help with the question you had, or to answer the question you had about absorption. I don't know if you guys mentioned cold storage, but that's a growth sector as well. People buying groceries online much more now than they ever have, especially the older generation. My parents are in their 70s, and they're starting to do that, which is a very interesting trend. And I think just overall with COVID, changing buying habits, and I know everybody knows this, but maybe just sort of to augment that, I think because of COVID, and people being cooped up in their homes and maybe thinking about their lifestyle and thinking about health and thinking about quality of life and those kind of things, that to me sort of portends to wanting to buy product online, because it's better product. I don't have to go to the store, of course, or go to the retail center, but I'm looking for healthier foods. I'm looking for exercise equipment. I'm looking to redo my study or my workout room in my home. So I'm buying a bigger home, or I'm redoing my home. So residential building supplies have been, pushing through warehouses significantly. Low interest rates have helped that. But just this overall sort of I want my life to be better, and therefore people will buy. And with 7 million people in the city or the greater MSA, if that's the number now, that's a lot of buying going on. And so as we continue to grow, I think we all believe that our population is going to grow. That just means that more product is going to be purchased, and a lot of it's going to be online.
Yeah, good.
Agreed.
I'm glad you guys brought that up about the larger tenant sizes, because I think that's a really important point about what's one of the biggest changes that we've seen in Houston. It was kind of, we saw it starting probably, what would you say, about 7 or 8 years ago, that trend began, and it's just kind of accelerated both in terms of deal volume and deal sizes.
If you look at it, sorry to interrupt you, Reeves, but if you look at it, and we've talked to a lot of different supply chain experts and retailers and e-commerce folks, and really the consensus is for Houston, and I'm surprised we've gone this long without getting a sports analogy in here, but in terms of the innings game, we're really, from what we can tell, we're in the 3rd inning of a 9-inning game in terms of e-commerce. So there's a lot of runway and upside in regards to e-commerce, and we're seeing it play out. Once again, a lot of those deals haven't hit the statistics, but there's a lot of supply chain retooling that's happening at a national level, and other markets have been prioritized over Houston in terms of getting the attention first, and that's really working from the coast. And then just now, people are saying, okay, now we have to figure out what's going on in Houston, and a lot of that was planned for 2020, and that's gotten pushed out to this year. So we still have a major tailwind in terms of what's going to happen with e-commerce here, and not just with the Amazons of the world. You really haven't seen a whole lot of other folks show up here yet, and we believe that you will. And then one other thing to point out real quickly, and Jeff can comment probably better than I can on this, but there's been a really robust user purchase market in terms of spec buildings that were built and are being acquired by users. And so we think that's going to help in terms of just this oversupply. A lot of that new supply is being taken off of the market, and it's not a massive amount in terms of overall square footage, but it will help, and it will pull those, that number of empty spec product down. So it's just kind of we see the intersection of, and most of those companies that are buying those buildings are local, regional, non-publicly traded businesses that have a ton of faith and conviction in their business, and then couple that with low interest rates. And at a certain price point as a developer, you hit a point of indifference where you're saying, okay, if you hit $85 a foot, $90 a foot, okay, yeah, sure, we'll sell you our building. And if you can't get to that price point, then we still feel confident in the lease up. But if you hit that number, then we'll sell it. So we've seen that play out across the city, and we're seeing that in some of our recently developed buildings as well.
Yeah, it's interesting how that's happened. I think you're right. It's largely driven by lower interest rates, but maybe also with the amount of supply, developers think, if I can get it, maybe I'll accept a little bit lower return. They're still making money on the deal, but taking a little risk off and go ahead and sell it to a user, where we really haven't seen much of that with new product in previous cycles.
Yep.
We're starting to run out of time, so let's jump into just kind of that's a good segue into the next topic was on sales, and we'll start with just kind of talking about the investment sales market, and I'll just comment briefly on what we're seeing, but basically that the cap rates are continuing to compress, and we're seeing cap rates in Houston on investment sales moving even below the 4.5 cap range for core deals. And then, other deals kind of pricing in that 4.75 cap, somewhere between a 4.5 and a 5 cap, depending on, any number of factors. But generally across all markets, cap rates are compressing, and there's just a lot of demand to buy industrial real estate. So it's an exciting time, but it is pushing prices higher. So that's kind of what we're seeing. But Justin, what are you guys seeing in terms of capital markets in your business?
Yeah, I think, you nailed it. 4.5 to 5 depending on, where you are in the city. For quality Northwest product, you're going to be at a 4.5 cap. If you're looking at something up north, you're probably closer to 5. If you have a long-term Amazon lease, you may be sub 4.5. But we think as we see these oversupply concerns vanish, hopefully by the end of the year, and we get down to a more reasonable level of vacancy, we think that cap rates are going to trend the same way, where they're going to continue to compress. And we've already seen it with our colleagues in Dallas and in Austin. They're one step ahead of us in terms of cap rate compression. So, you can kind of see the future in terms of what they're experiencing. That will come to Houston and will play out. We just got to get some of these misconceptions about our market cleared up. And the best way to do that is get some of this product leased and show that it's legit in terms of what we're seeing.
Yeah, totally agree. Jeff, anything you want to comment on there on the?
Yeah, I think you got
investment or user sales.
Sure. I think you guys covered it. It is interesting that despite sort of the misconception out there, there is a considerable amount of investors that do want to be in Houston, that do believe in this market and that are kind of following the trend and following the crowd, if you will. So we are seeing that. Back to your comment on the sales market. Yeah, in my 20 plus years, I guess never would have dreamed that users could go buy shell buildings, right? But that is happening. You're right. It is the local regional type user, but that could help, with the supply scenario going on, or a building that is just kind of continue to sit. The developer may be willing to exit on just a sale. We were competing on a deal. In fact, it was probably our number one choice out of Northwest Houston, and the owner developer decided to just go ahead and sell the building that we were looking at. So that had never happened to me. Thankfully, we had a few more options to look at because we were looking to lease. But it's interesting. You've got a lot of different little dynamics going on. But I think it all just is good commentary, or a good supporting factor that this market is healthy. It's got vibrancy. It's diversified on many levels, more than maybe it ever has. So we're able to take advantage of that and enjoy, just kind of some variety here in Houston. We're not as oil and gas centric as perhaps everybody thinks we are. It is definitely important, but it's not driving everything.
Excellent. Well, we have time for one more, Todd, or should we wrap it up now?
We got 2 minutes. If you got anything you want to talk about, let's do it.
Yeah. So there was one other topic. Let's go to, I think this is one that maybe we're touching on, but oil prices, I think part of the reason, and just for everybody, the Wall Street Journal article that was mentioned earlier, I think the headline was something like "Houston, we have a problem," and it was an article that kind of, to me, it felt like it was maybe a little bit late. Maybe that was the case 6 months ago, but I feel like we're on an upswing right now from the demand side, and so, but. I think some of that happens, when you have an event like we had last year with oil prices going negative, and then you start hearing about this wave of development, and somebody from New York might look at that and think this is going to be a disaster. We've been through these cycles before, but so anything quickly you want to say about that issue, and then I'll go with Jeff first, and then Justin to follow up.
Yeah, that's where we need our man John Ferruzzo, right?
Right.
No, we're seeing a couple guys in our office have spent a lot of time selling, kind of smaller crane serve manufacturing buildings. And yeah, we're seeing an uptick in activity, price of oil going up, just a little more stability out there. And one trend we also see at times where Houston benefits is when there are some challenges, is that, we call it companies kind of coming back home, whether it's a headquarters or just the consistency of Houston, or the fact that that's, energy capital kind of thing. So we do experience some challenges in the oil and gas market, and we're still, kind of in that, especially in the drilling side. Groups may shut down an operation in another area of the country or even the world and come to Houston. So, but our guys have seen an uptick in the last probably 45 days. And I think John conveyed that as well for Rizzo, that the level of activity has definitely taken off in the manufacturing side. He's got a couple buildings under contract. I know Richard Quarles in our office has seen really good activity on some of their manufacturing buildings. So hopefully that will continue to pick up throughout the year.
Yeah. Justin, any final comments on that?
I mean, I think the key there is the institutional side of the market is not necessarily correlated with energy prices. It's much more consumptive demand based, and we have 7 million people that aren't going anywhere, and oil prices are increasing. So we're very optimistic about Houston industrial.
Totally agree. Yeah, great job, guys. Thank you.
I just saw that oil retreated a little bit. April 21 oil came back from 62 to 60, but it's still at a high. So what I've heard people say, oil at $70 oil is good for Houston. Where do y'all see it? And I'm not that I'm going to trade on this information, but where do you see it going?
Well, I've kind of learned, Todd, that I probably shouldn't give any forecasts on oil prices because I'm almost always wrong. But I'll just say that I'm hoping that it goes a little higher. 70 would be great.
Yeah, 70 would be great. 60 is kind of a good. I guess we would say that a year ago that would be awesome if it gets to 60, and that's where it is. But yeah, 70. But I know that north of 60, that's probably why we're seeing the activity, is that it's a healthier figure. And these companies got to be real efficient with what they're doing anymore with technology and everything that goes along with drilling these wells. So hopefully we're on the upswing there.
I loved your comments too. Onshoring and nearshoring is a real thing. It's happening. Boots on the ground say they're looking at leases and companies. So that's great. I need to make a plug we have an upcoming event in March with a ton of people already registered on that. We're going to kind of head down to the Rio Grande Valley, but it affects Houston and Dallas and everybody, because the more those companies move back they're coming to Texas, right? Or they're coming to Mexico. Okay, well, this was a great panel. Thank you, gentlemen. I'm going to do a little bit of housekeeping here real quick, share my screen. If you're on the next panel, now would be the time to activate your camera and microphone. If you're not able to do it, I can do that on your behalf. But just real quick, let's do some housekeeping. Share my screen again. This is you probably saw this. You probably clicked here to get to this event. It's pretty hard to find it without doing that. But I wanted to show off our virtual lobby because this is our one and only chance to do some networking in the online environment. Well, except for the chat room, and I'm going to bring that up in a second. But this is our panel that just finished up. Good looking guys. But below their name, well, a couple of things. You can see here what they're talked about in this case, but upcoming panels, what they're going to talk about. But you see below their name, there's a little LinkedIn button. That is a good chance to reach out to these folks. Befriend them on LinkedIn if you don't already know them, and reach out. At least it's some kind of networking we can do in this silly virtual environment. But here you go. Here's the next panel coming up. You see our moderators, Kevin. He's probably getting ready to go in the background, and I'll step out of the way. But just wanted to make light of this. Use this. You can see if you want to learn more about our sponsor companies. That's all here. See some advertisements. You can also find out more about our newspaper and our company. Sorry, that was a quick shameless plug right there. Are you gents ready to go? I see I've got more faces than I have panelists for this. So if you're not,
Thanks,
not
everyone.
on this panel, yeah. Oh, you and goodbyes. Thank you. Sorry, gentlemen.
Thanks, everybody.
I do need to make a quick plug for the fact that I haven't seen any female people on this panel or the last. I can assure you we very much try to balance our panels all across the nation between male and female, black, white, of all colors. We really, really, really pay attention to this. And in fact, our Houston office, we only have one male in our Houston office. So they're paying attention to it. I think it's just a reflection of it wasn't an oversight, just a reflection of the industrial industry and these great minds. So I don't need any more nasty emails. You don't have any of my females. We'll keep trying. Okay. We'll get you on the next one. All right. Well, thanks. Kevin, you ready to roll?
Yes.
All right, I'm going to step out. You all need anything, just holler, hey, Todd, I need something. But otherwise, I'm going to stay here in the background. Do not forget to use the chat room. It's a great place to also network. There's 200 people online right now. Say hello to each other in the chat room. And don't forget to click the box for all attendees so everybody sees it. Thank you. Bye.
All right. Well, first, I'd like to thank everybody for attending today. Also thank Red News for allowing us to be part of this panel. This is going to be an exciting topic. Let's talk about the state of development and I'm excited about the panelists we have. But before we begin, I want to, hope that everybody out there is doing well. We've dealt with a freeze last week, and hopefully everybody's homes and families are doing all right. And I think it's sort of interesting. A week since the freeze sort of started going away, we're going to have 76 Chamber of Commerce weather, and hopefully that's indicative of our industrial market where we're resilient. We've got through COVID. We've started this year, and I think we'll hear from everybody talking today that the resiliency of Houston and how strong the market is rebounding. So with that, I'll introduce myself. My name is Kevin Sager. I'm Vice President with East Group Properties, responsible for the Houston, El Paso, and New Orleans markets. We're a publicly traded REIT that specializes in institutional grade industrial property. And so with that, I will let the other panelists introduce themselves, and we'll start with David.
Good morning. Thank you, Kevin. I'm Dave Wheeler. I'm with Hartman Income Reit. We're a private REIT based in Houston. We publicly report, but we don't trade. And we have assets throughout the state, Houston, DFW, San Antonio, and about 60 properties, about 775 million assets under management. My job is to oversee our investment in this region, and we're active. So thank you very, very much, Kevin.
Gary? Gary, would you like to tell us a little bit about yourself?
Yeah, Gary Mabry, principal here in Houston with Colliers. I am not a developer. I'm not smart enough or brave enough to be a developer, but they put me in here with some learned people, and so I can get a little different perspective from the brokerage side of the business. Been here a long time, as you can see. I'm really only about 32 years old. It's just a tough business to be in. So.
Yeah, I like that, Gary. And Charlie?
Yeah, Charlie Meyer. I'm the president of Lovett Industrial. Lovett is a relatively new company. We were formed about a year ago. Many of you are probably familiar with Frank Liu through Lovett Commercial and Lovett Homes and In-Town Homes. And Frank and I formed Lovett Industrial together to focus on industrial investments nationally. And we're growing fast. We're currently active in 5 different markets. And we're extremely active in Houston specifically, where we have about 2 million feet of projects under construction right now. Thankfully, most of which is pre-leased.
That's fantastic. And I'm excited about this panel. We have a good group of backgrounds. We got developers, capital investment groups, and tenant representation, agency representation here. So let's dive right into it with the question. Let's talk about the development numbers this past year. How was it leased, supply, demand in Houston from new construction? And we'll start with probably Gary on that. Might have some more statistics from overall market and sub-market.
It's it's been a little bit of a moving target in terms of what was started last year, what's been actually put on the ground and so forth. So depending on whose numbers you use, I use Colliers, which Lisa Bridges, I'll give a shout out to her. She's our research, heads our research group. And you're talking about, 20 to 25 to 30 million square feet have been either started, brought out of the ground, or completed within the last 12 months. And that continues on into 2021. We saw some of the projects momentarily halted. They're coming back out of the ground at this point. So again, I think you'll probably see something in the range of 20 million square feet delivered this year. It'll be interesting to see. The prior panel brought up, they track deals in the marketplace as we do, and there's conceivably 15 to 20 million square feet of tenants out there at this point in time. Now, how many of those make, we don't know, but that would be remarkable if we can take that net absorption, and because we do have some marketplaces right now that are oversupplied.
All right. No, that's good information. Charlie, you got anything to add to that?
Yeah, I think, as Gary said, there's a ton of supply. And I think COVID gave us a little bit of relief on that front. I think really before COVID set in, the market was recognizing that we were getting overbuilt, to a degree that probably is a little bit more than the market can bear. So, I think that I'm surprised to hear the 20 million foot prediction for this year. I would have expected it to be a little bit less than that this year. But, I think the tenant activity has been encouraging, to say the least. I think, everything that we have available that's under construction has good activity on it. And we also control somewhere around 200 acres of land in Houston for future development. And we've seen really encouraging activity on that land from a build to suit perspective. So, despite the headwinds, I remain optimistic, as I think most developers, intrinsically are pretty optimistic about the places where they're doing business. So I'll concede that I'm very biased, but based on what I'm seeing on the ground, this doesn't feel very different than, the way Houston has behaved in the past, where it ebbs and flows, and there's always big waves of construction followed by waves of absorption, and that appears to be playing out to me right now. So I'm going to remain optimistic.
I like it. And feel free, all of y'all, to jump in where you'd like to add. One of the things I found interesting is one of the large real estate companies has reported that groundbreakings have dropped, where significantly, I think one reported we're down to, this past quarter was 1.2 million square feet of groundbreaking, which is down from 4.3 the quarter before, 6.4 and 7.4 as you go back, to the beginning of 2020, which is encouraging to allow supply demand to catch up.
Right.
Which submarkets do you guys think might be oversupplied, and which ones do you foresee? How do you see that changing over the course of this coming year?
I'll give you my take on it. There's still a significant amount of inventory in Southwest Houston. I think everyone, in the last panel beat up North Houston pretty badly. North Houston is also fairly soft. But, fundamentally, I think the product that's in Southwest Houston is well located and high quality product. And I think it'll lease at a steady clip this year. And, the interesting dynamic about Southwest Houston, and to some degree, which is crazy to think about today, but even North Houston has a similar dynamic, is the traditional areas of these submarkets have very little land left. So it's hard to imagine a situation where longer term there's a major supply and demand imbalance in both of those submarkets. I think the Southwest Houston submarket specifically, there's really not much left to build on after this current wave of inventory is leased. And so you have to wonder where all that activity is going to go once it does lease. And that's kind of what I spend a lot of my time doing, is trying to figure that out. But I think when you look at those two areas, there's a good bit of vacancy. But fundamentally, I think there's maybe a few problem projects that may have trouble, but overall those areas will probably have a pretty good year. And then, what's more interesting to me is probably all of the activity and kind of the positions that people are trying to gain further out northwest on Highway 290. There's a significant amount of land that's tied up out there for future development, and I think that's going to lead to a significant wave of construction probably later this year is when we'll see that start. And then you go out to Katy and Brookshire where we see Streams project way out west, and you have Clay there and quite a few others that are building, further out than where we've typically seen spec historically. But when you think about the dynamics of why that's being done, it all makes sense. That's where you can build bigger boxes. There's certainly been more established tenant demand in that size range recently. I think it remains to be seen whether those tenants will lease spec space as opposed to taking the time to go forward build-to-suits. So I think that's really the bigger question, is how much of the spec space that's bigger is going to get leased to a single tenant versus going build-to-suit.
Yeah.
I would kind of piggyback on that. Most of my activity in the last few years has been over on the southeast side, far east side, LaPorte, Pasadena, Deer Park, Ship Channel, and so forth. As Charlie brought it, there some of those markets, particularly south of the channel and on that east side of town, very few sites remain, certainly no large sites for multiple building configurations. That's why we've seen a lot of these developers move across the channel into Cedarport, Ameriport, some of those areas over there. You're seeing some of your bigger boxes. Floor and Decor just announced 1.5 million square feet over there in Cedarport. There's 1 million square foot spec going in and so forth. So a lot of people anticipating continued growth in the import and export market and being able to provide close-in warehousing and distribution points. So, short of that, you're seeing people jump out to Richmond or Rosenberg. I mean, it's everybody's always looking for the next best place. I'm not sure where that is, honestly. You've even got Lowe's moving up to the Porter area, proposed buildings up there following that. So a lot of areas that I think, as we said, 5 years ago, we probably wouldn't have thought about being as extended as we are, but it's still a very dynamic marketplace. And the bigger boxes, which that kind of brings up, the bigger boxes are being, it's anticipation of the much larger tenants. The smaller guys are not going to fit in those places. They're just not made to break them up into even the 100,000 square foot spots. So I think that's why you'll see some of the older Class B properties, the smaller buildings, particularly the front loads, should do very well in the coming years. Because the new property is not being built to accommodate the smaller user.
Yeah, that's a great point, Gary. We're seeing good activity on our assets that cater to smaller tenants. They're mostly infill locations, and there is robust demand there. Our occupancies are strong, and we're still getting a little bit of rent growth. Like the challenge for the bigger properties with the large vacancies is rents will probably be flat in a number of submarkets for this year as demand catches up. So I think the developers will have an easier time later in the year, perhaps early next year, kicking things off with lower vacancies, a little bit of rent growth in place, and kind of some positive dynamics moving forward.
No, and this is a good segue into, we've all talked about tenant needs and tenant demands. Let's segue into, anticipating and meeting the tenant needs. And I'll throw in build-to-suits with it. We have a fair amount of speculative development that's taken place, but I think a number of the products you've mentioned, the Lowe's, the Medlines, the Ross, have all been build-to-suits owner users. Do you foresee, are we building to what the tenants are requiring now? And maybe touch into what the tenants are requiring today, and will we see will you continue to see increases in build-to-suits, or will our spec development be able to meet those needs?
I'll go first. You know, my opinion on that is, you know, it's interesting when you look at the larger bulk facilities that have been built, and I do think that they will all ultimately get leased. I think that you've seen better success with bigger boxes built speculatively on the east side of town than other areas. And I think that is intrinsically because the tenant base on that side of town is very accustomed to the standard warehouse with a small office and you know, more of a market level of trailer storage. And so that type of building seems to make a lot of sense on that side of town. Whereas if you go to the west side of town, you're more oriented towards consumer goods and e-commerce. And it seems like the tenants that are wanting this larger space on that side of town want a little bit of a more specialized building. So I think you've seen the larger, bulkier facilities, call it, you know, from 59 to the west on the north side of town, and 45 to the west on the south side of town. They've struggled a little bit more when they're built speculatively, because the tenants that are leasing that size space are requiring something a little bit more specialized. And so a lot of those buildings you're going to see get cut up into smaller suites that will, you know, where the smaller tenant size is okay with that type of building. And that's not to say they'll all go that way, but I think that you're going to see more go that way than not on the in the western half of the city. And I think that's primarily why.
Gary, are your customers, what are you hearing your customers are looking for in these new buildings? What trends are you seeing that they want to see? And as developers like Charlie and me go build new buildings, and David goes acquires new assets.
Yeah. You know, again, being on the east side and import export, one of the key things they're all looking for is trailer storage. You know, the more chassis you can leave there, the more trailer storage you can find, the better. Typically, as Charlie, I think, mentioned, you know, typically the office requirement is not that heavy. Now, when you get into the e-commerce, those guys have a whole different auto park requirement. They've got hundreds of warehouse employees in there that have to park somewhere. And so that's driving a whole different dynamic in terms of land use and so forth. So, you know, we see everybody expects to have dock levelers now. A lot of them now are looking for, particularly the consumer goods guys, they all want dock packages on there. Of course, LED lighting has become standard. 32 foot is probably the absolute minimum for anybody looking at newer product. 36 has kind of become the norm, and 40 foot seems to be the new norm for some of the buildings coming out. So I would think, you know, more land utilization for vehicle parking, whether it be auto parks and so forth, and secured parking. So that's another big issue. Being able to fence off, if you've got a multi-tenant building, being able to configure it to where you can fence off and give both, you know, trucks security access as well as the auto parks. I will say Houston's a market where you can put out all the really pretty flyers you want to, but until you actually start bringing something out of the ground, I don't think you're going to get that much play from the tenants. having spec office in your project is a real key. We've seen that with speed to market that these guys want. We've made a couple of deals there on the east side simply because we had spec office space already built out, which enabled them to get in there and get operating without having to go through a permitting process with the cities and so forth and delay it over, 90 to 120 days additional. So those are the key.
No, I think those are all real good points, and I think we've all seen it. We've seen, sizes of buildings, the clear heights have increased, the demand for trailer storage has increased, flexibility to expand a tenant within a building or within parks have all been noticeable. How have you seen the interiors change? I mean, with COVID, what is your predictions with changes to the interiors? Do we see office space increasing so they can be more spread out, or do we see more, not as much requirement for office space in our warehouses?
I might let Charlie take that one.
Yeah, the as far as the impact of COVID on the building design, I think it hasn't impacted industrial very significantly as far as I can tell. We're building for some national tenants, and they haven't changed their prototype or made adjustments that are material to the way their operations are running from a physical perspective in these buildings due to COVID. I know they have their new protocol as far as social distancing and that sort of thing to keep everyone to keep everyone from spreading the virus, but it's not something that I've seen impact the amount of office or anything like that.
Okay. Excellent. And David,
I would agree with that in the sense that most of the big bulk warehouse are not people intensive in the office area. Where you may see some changes coming would be on the flex product, when those guys are more where you have the showroom, retail, 40%, 30-40% office finish out, or at least climate control finish out. That's probably where you may see some more with the space requirements and the social distancing and so forth, would be my guess. But I haven't seen it impact anything that we're handling at this point.
David, are your customers, your tenants bringing up new requirements, new demands that everybody should take into account when they're developing a new project?
Not really, because I think, most assets, industrial assets, except for the flex category, office component is low enough to where we don't really see dramatically increased office demand in those industrial properties. But one of the things we are seeing that's interesting. I'd like to circle back to a comment that Gary made on trailer storage or trailer parking. We've actually worked with one developer that sees that as an interim use. They're acquiring sites, paving them, doing the trailer storage with the expectation of redeveloping the site, somewhere downstream to cater either to a spec or build to suit opportunities. So that's a trend that I'm seeing. It'd be interesting to see if that expands or if that's just kind of a one-off situation with them. But no, in terms of impact from the pandemic on office use, office utilization within the industrial assets, we don't see a dramatic change there.
Interesting. And we can't go talking about new development without talking about lead. Now that we're seeing more customers that are consumer related, the Walmarts, the Home Depots, the Lowe's, the Amazons of the world. Are they pushing down more requirements for our buildings to be constructed to LEED standards or not?
We're not seeing a requirement for the most part, with some exceptions, to build to a LEED certification level. I think that's primarily driven by the fact that these warehouses, especially the big ones, the e-commerce related ones, they consume a lot of power. They're typically a fully air conditioned warehouse. There is certainly a lot of focus from everyone, every stakeholder on energy efficiency, and just being conservative as far as how we build these buildings. But it's hard to achieve the LEED certification for some of these projects just due to how specialized they are. There's really not a criteria that's out there that you can use to qualify in some cases. So I haven't seen it become a mandate, but that doesn't mean that these companies are not focused on energy efficiency and things of that nature. It's just not. It hasn't translated into a LEED certification.
All right. And I'd echo that too. I just had to bring it up because 4 years ago, that was the big discussion. And some of us spent a fair amount of money to get a piece of paper on a wall, but most of our buildings have a lot of energy LEED standards already built into them without actually having the certificate. So I just wanted to ask that. Now, as we talked about, and I think the panel before us got into, they want more, customers want more trailer storage. The clear heights are getting taller. There's probably more bringing in some natural light into the facilities for customers, more parking. All that comes with a cost. So where is construction cost today, and where do you see it heading, and what are some of the drivers for that right now?
Yeah, it's a really interesting time right now in the construction world. I think many of the real estate sectors are very slow, probably with the exception of industrial and multifamily. And you would think that would depress the construction cost quite a bit, just given the overall market seems like it may be a little bit slower than it once was. And we did see a noticeable dip in construction costs when we initially went into COVID, kind of middle of last year. And in some cases, we were able to take advantage of that, which is great. But you've seen prices actually begin to spike more recently, and I think it's primarily on the material cost side, and it's due to the supply chain disruptions that are occurring globally relating to the raw materials and the manufacturing process associated with many of these materials that show up on the job site. And so I would say that right now, we're probably seeing costs that are at least 10% higher than they were pre-COVID, which is a fairly dramatic increase. And I think you've seen that cost actually during COVID, when you take into account the kind of the discount, maybe we saw a 10% or so discount initially, they've gone up 20%. So maybe 10% net overall from pre-COVID to now, maybe a little bit more than that. The biggest driver is steel. And when you think about it, it makes sense. Steel production slowed down dramatically due to COVID. But we all see how many warehouses are getting built across the country. It's not just in Houston, it's everywhere. And they all require the same types of building components. And the same types of structural steel systems. And so the manufacturers have not been able to keep up with the demand. It's caused a price spike. And we've seen prices increase in the last 2 months, about 60% for steel. And that translates to a significant and noticeable increase in the overall development budget. And that price has not begun to normalize yet. It's continuing to go up, which is something to pay attention to as we kind of go into this year. I think everyone's really optimistic about the fundamentals that seem to be showing through for the year from a leasing perspective. I I think that the supply side could have some challenges, just given the higher cost of construction. I think it could make build-to-suits potentially a little bit more difficult. It could make build-to-suits more expensive when sometimes they can be less expensive options for tenants than leasing a spec building, just because the cost of construction is so much higher right now than it was if you built a building that is now finishing versus starting one now. You're at a little bit of a disadvantage from a basis perspective.
No, I think that's a excuse me. I think that's a great point, and I'm wondering how developers and brokers and our community will deal with the rising costs, especially when it comes to a build-to-suit. You send a proposal, and the time to make the deal takes, has been extended and prolonged. That we've noticed that the pricing and the underlying costs of construction might drastically change in 2 to 3 month time. And so it'll be interesting how that gets conveyed or relayed or incorporated into the proposals that we're sending out.
Yeah, I think it will probably shelve a few projects. It's like I said, it's a noticeable cost increase.
Right, which could help with our supply, potential oversupply that we have, start going into more of the spec buildings that we currently that are currently delivered or about to be delivered, and bring us more to an equilibrium, and hopefully encouraging signs for the rest of the year until pricing stabilizes. What is the panel's thoughts on pricing going forward, and how long will the pricing be sustained? Because if the impetus for a lot of the construction costs to go up was COVID, plants being shut down, demand from industrial construction throughout the U.S., do we foresee, as the steel mills are being brought online, do we feel that's going to help make prices stabilize going forward in maybe the third, fourth quarter of this year?
That is the hope and expectation. Basic economics, price is high, so we should see more supply come online which will lead to a normalization in the cost. But the flip side of that you can't ignore is that there's a lot of euphoria in our business right now, and this is a national business. These warehouses are getting built all over the country. This demand for the steel is happening everywhere at a very high rate. And so I think the biggest question is, are you going to see a pullback in tenant demand or tenants willing to compromise for space that may be existing that they would rather not lease, rather than going into a brand new building that's more expensive? And I don't know the answer to that question. And so therefore you can't say with certainty that the price of steel is going to drop for sure in the third or fourth quarter. But I think you can say that the supply of these raw materials will increase, and hopefully that will lead to a normalization in the cost. But given the demand and how high it is everywhere, there's some risk that doesn't happen. I mean, I think.
Yeah, I agree that there is a risk. I don't think that demand is going to slow down. In fact, I think with the level of fiscal and monetary stimulus that's out there now, and it may come as a result of the packages being considered. I think you're going to see a dramatic uptick, continued uptick in demand as the economy switches to the cyclicals and the other industries that have lagged over the last year or so. So my expectation, and the analysts talk about this, given that we're in a new commodity super cycle, is that these commodity inputs are going to increase in price. You've touched on the key ones, Kevin. Charlie, that are inputs, key inputs into the development game. But anecdotally, there's other indicators that we're entering this commodity super cycle. Copper's at a 10-year high, corn's at an 8-year high, and they've spiked dramatically since last year. I think there's no expectation that on my part that pricing's going to slow down on the increases anytime soon.
Well, with high construction cost, and we touched on land being available land, infill land being sparse, and people looking out, where do we see land cost? That's another component to development. Where do we see land costs, and how is that going to be impacted by the new detention requirements that are being implemented, where we might have to, increase detention sizes 50% to maybe even 100%, all impacting cost of land. Let's transition to the impact of where pricing is for land in the various submarkets, and where's the next spot that developers can go, and is the detention requirements, how is that impacting development sites?
Well, it's certainly making things a little bit more complicated, and it's not an easy answer. I mean, I think, in general, what's happened with industrial land, and not just in Houston, but everywhere. Maybe it's been a little more dramatic in other markets than in Houston, because Houston still has a fairly robust supply of land available. But you've seen significant and noticeable increase in pricing for infill land in Houston. And, these industrial projects, they consume a lot of real estate. It requires a lot of land to build them. And when you look inside the Beltway, there's not very much land left. So it's just basic math. The price is going to go up. And you've seen the price begin to increase fairly dramatically over the last couple of years, notwithstanding the detention issue, which further complicates the situation. So I think, when you look at, how the detention component, translates to the overall land market, it's hard to say that it's just going to create a pricing increase. I have to believe there's going to be some concessions on landowners if they want to sell today. Their land is probably worth a little bit less than it was before this detention requirement came into effect. But certainly it's also going to be more expensive to develop. And I think there's going to be a balance, and it's not going to be a net nothing. It's going to be a net increase in rates. And so I think it helps point to a more of a rent growth story for Houston. And Houston, traditionally hasn't been a great rent growth market. That's one of the things that institutional investors harp on about Houston. It's always had a tough rent growth story. But when you look at the dynamics today, getting further complicated and exacerbated by these new detention requirements, I have to believe that at this point, we are going to start seeing real rent growth here. And, you look at a place like Dallas, where, you've seen, a significant rent growth in infill markets there. And for a long period of time, for all of history, Dallas has not been considered a great rent growth market up until about 4 or 5 years ago. So it can change, that dynamic can change. I think Dallas is a good example of that. And I think we'll start to see a change in Houston for similar reasons.
Gary, Charlie brings up a good point that as construction and land all increase, somebody is going to have to absorb that added cost. And so where are you seeing the impact of that on rental rates?
Well, yeah, I mean, you're right. And it's easy to say you can pass it on to the tenant, but that's where they balk. That's, I think as David said, that's another reason why you see the Class B, some of the older product will continue to do well. I think the new product that's coming to the market right now is not, you know, if you were going to start today, as Charlie said, you're going to have some significant cost increases. I think one issue on COVID that you brought up earlier, I was thinking about, and it impacts delivery to the market, and that's, we're seeing significant lag in getting permitting completed. You know, the cities don't have enough people down there. The people they've got may or may not be, you know, attentive to what they're doing. And I mean, we're seeing just the permitting process drag out, which is costly both in carry for the developer and for the tenant waiting to get in. So a little bit longer lag time in getting people to the marketplace. You know, the detention issue, I mean, at some point, where do you push the land cost? You know, I can remember, you know, it used to be, wow, $250 if you had to pay $3 a square foot for a piece of land. You know, it just didn't make economic sense for industrial. Well, you know, we're past $5 at that market. Where is it? I mean, can you still do a bulk product at $8? You know, it's interesting. I think that's one of the things that obviously is driving some of these more rural markets, where you, particularly for the big boxes. Charlie and his group developing infill sites, I think is going to be challenged probably more than some of the other folks. And the flip side of that is we've seen some of the bigger institutional players in the Houston market have actually decided to sit on the sidelines for the next year or so. I mean, they don't want to do any development, waiting to see what's going to happen with cost and the absorption of the product that's already here and already coming out of the ground. So it's a mixed balance. I do see some of the other, some of the groups are willing to look at shorter term leases now in order to provide, you know, an income stream for a big building. So whereas in the past, you didn't want anything less than a 5-year deal. I mean, we've seen some 2-year deals out there from even the institutional people. So they're doing what they can with incentives and so forth to control the cost, but ultimately it's going to cost more to build them, and somebody's going to have to absorb it, and it's going to be the tenant at the end of the day.
Yeah, I think there's a lot of logic for doing short-term deals too, because if you can get somebody to cover the next year or two, you're going to get past a market where there's, you know, high single-digit vacancies, and then your existing product is going to be better positioned than new product, which may be facing higher construction costs and need to achieve higher rents. So I think I really like the idea of doing short-term leases as a bridge to the future.
Yes, no, that all very interesting. And I know we've you know, as an institutional developer, we delivered 4 buildings this past year, and I'm glad to hear that because of rising costs that we might be surprisingly a lower cost provider with a high quality Class A product. So that might be an interesting turn of events right now. But no, I think rising rental rates and potentially that will impact yields because the developer or will have to absorb some of this. And I guess that leads into, you know, new development, you know, how is it financed? How is acquisitions? What is the exit strategy? Obviously for an industrial REIT like East Group, we're long-term holders of real estate. So we're, you know, spending a little bit more time and more cautious of long-term holds and making sure the products are designed for something we'd want to hold for many years into the future. But how is the capital, we're seeing rising construction costs. We've talked about supply, which we think is, we've touched on a little bit. That activity has, at least the panel before us, activity, I think this first quarter will be surprise a number of people outside of Houston. I think the Houstonians realize where we are and how resilient the market is, but I think we'll have some encouraging leasing numbers this first quarter. But where do we see capital flowing into Houston right now? And what type of product are they focused on within the industrial? David, you want to jump in on that?
Sure. Yeah. We're tracking. I think everybody knows mid last year, there was this intense focus from the institutions on industrial because there was a lot of concern about where office and especially retail were headed. So amongst the major commercial food groups, industrial really was the big winner last year, not only from a performance standpoint, but definitely from a capital standpoint. I think that's moderated just a little bit, not a lot. I think industrial demand from a capital standpoint is going to be tremendous this year, but it does seem like it's off a hair, and there's a couple of reasons why. I think the capital is starting to look at the other property types, not so much retail, but perhaps office and some other spaces, and think about not getting too focused in one area in terms of their new allocations. And the other thing is we're seeing less industrial come available for sale than we did kind of at that peak period, late summer, early fall last year, when everybody was trying to play catch up from not only a sale, but a getting the capital out standpoint. So the other driver at this point is institutional capital is tracking, real yields, and those are dramatically rising over the last couple of weeks. So everybody's a little uncertain about how that's going to play out in pricing and cap rates. But I do think the institutional groups are still going to continue to pursue the properties that are leased to credit tenants on long-term leases, as well as the larger, newer distribution or warehouse facilities that are they're modern. So probably the change this year will be folks will start to look more intently at the B infill assets, like we've talked about, as those start to get, maintain their occupancy, perhaps get some rent growth.
That's very interesting, especially the other panel before us also talked about rising rent growth in the Class B product type. So it's support that there be rising prices from capital markets and the Class Bs. For new development, I think last year and the year before that, and leading up to the wave of construction that we had, there's a lot of capital flowing into forwards spec buildings where parties would just go ahead and buy them out as when they get the C of O. Do any of the panelists see where do you see the forward market right now on spec development?
There's relatively limited appetite from what I can tell. I think, opportunistically, if it's a great location, it's very possible. But when you look at the softness of certain submarkets, it's going to be hard to pull off a forward sale in a place like North Houston right now. In all likelihood, at a price that a developer like me would find to be acceptable. I think as the market tightens up, as hopefully the first quarter numbers come out, we start seeing the fundamentals improve. That will certainly become more viable. There's so much capital demand for this product type that I think anywhere you can make sense of an opportunity, you should be able to find money for it. But the headwinds Houston has is its vacancy rate is higher than historic norms, and the perception is the oil and gas business is going to create some headwinds for us as well. So whether that perception is reality or not, I think most industrial people would say that they don't believe it is, but that's the perception, which really is dictating how aggressive these investors are willing to get in a place like Houston right now. When you look at the when I look at how things are trading in Houston in general, it's interesting. It seems like Houston is trading at somewhat of a discount. Even more core-oriented projects, with some exceptions, single tenant net leased, long-term lease buildings are trading at comparable cap rates to places like Dallas, other kind of primary top tier markets. But when you get into more of the multi-tenant side, we are, it seems like we're in the high fours on a cap rate basis right now, which seems to me, based on, comparing to other markets where we're active, is a discount. And I think that's kind of interesting. When you look at Phoenix, for example, comparable buildings in Phoenix right now are mid four if they're multi-tenant. You look at Denver, they're probably more like a low four. And these are markets that don't have the same, kind of fundamental structural drivers of industrial that Houston enjoys. And so I think, the headline risk that Houston kind of presents is definitely making the yield a little bit higher here. And that's one of the reasons that I love Houston. It ebbs and flows a little bit more than most markets. So, if you're in the market here and you have a good feel for, where logical investments should be made, you can do really well through the cycle here compared to other places where it's a little bit more even keel and leveled out.
Which I find interesting that, and I think it's encouraging that if there's less money flowing to the forwards, it might tighten the market and allow, more capital flow to the existing, leased up property, build to suit product, which will help the overall market overall. And it does have some interesting aspects with capital and everything with cost. David, where do you see cap rates for Houston? Charlie touched on it a little bit, but where are you seeing the cap rates in Houston these days? And
yeah, they're a little above the national average, and I think the key there is a couple things. He kind of touched on it. Houston has low barriers to growth, and in some of those markets like Denver, which may not have as robust needs as other cities from an industrial standpoint, they're just they've got barriers there. So you can go in almost any direction in Houston and find land, even if you have to keep going further and further out. Ultimately, you reach the coastline, but you've still got a lot of land out in the green fields that you can keep going to. The other thing is just perception, and whether it's reality or not, Houston's still perceived as kind of the energy town. I think that pendulum is swinging rapidly. The analysts were predicting, mid 60s oil by the end of this year, 4 to 6 months ago. We're almost there already. So that the energy play is going to swing back in Houston's favor if it hasn't already from a perception standpoint very quickly. So I think that will help on cap rates.
No, excellent. And I see that we have a minute left, so we'll do some closing thoughts. I think what we've heard today was very informative. I think it's encouraging. I think it shows the resilience of Houston. And it shows that those that know Houston intimately realize that despite the challenges we faced last year with COVID and headwinds from oil and gas, we're seeing that our 7.1 million consumers are consumers. And it's being recognized by the deals this past year from all the, with e-commerce and the traditional named consumers out there, with the Lowe's, the Home Depots, the Amazons, will continue to fuel and add more desire, more need for industrial space in Houston. And it's, and I think we're seeing signs of rebound. We always face some challenges, and it's exciting. So thank you so much for all the panelists that are joining today. Todd, I don't know if you want to jump
Still
in.
here. The magic of TV. Kevin, what a great panel. I got a lot of comments in the chat room that they really liked what y'all were saying. So if you're on the next panel, now's the time to activate your camera. Panelists leaving us, now's a good time to say goodbye.
Thank
I'm
you.
going to share my screen again. Just give me a
Thank
second.
you. Enjoyed it. Thank you.
Yeah, fantastic. Two things real quick. I want to put in a plug for, this is coming up. If you can see your screen right now, our awards show. So this is it's my second favorite event. The Women in Real Estate event's my favorite. But we do this awards gala. Last year, it was right in the middle of COVID, and it was awkward. And you're not in the middle of COVID, but I mean, right when it was kind of breaking out. But this year, we're going to do a great job. It's going to be like going to the Oscars or close to it. But just make you aware that this is coming up. We will have industrial categories for broker, developer, development, all of those things. So just keep that in mind. But what I really wanted to highlight is bring you all back to our virtual lobby here. This is the next panel coming up and what they're going to talk about. But the key here, don't forget to do this. And I'm going to do it right now when I go off air here, is just click on these little LinkedIn buttons and you can say hello to the panelists and connect with them on LinkedIn. Let's see. Let me get back to, it's my weekly comedy show. Watch the old guy try to work the screen share. So Craig, you're here. You're ready to rock and roll. It looks like we might be missing somebody. Am I right? Walker, Marine, Robert. Where is Robert? There we go. There he is. Okay. Robert, I might have turned your camera off. That might have screwed things up for you because you popped in the middle of the last event, but looks like we're all set.
We're in good shape.
I'll be here, Craig. If you need anything, just holler. Hey, Todd, I need something. Don't forget about the chat room. Don't forget about the LinkedIn, and have a great panel. Look forward to talking to you when you're done.
Thank you.
All right, great. Well, thanks, Todd. I appreciate the handoff there. And thanks everyone for joining us here this morning. We just wrapped up a really good panel. We're looking forward to another good session here. Really focused, as Todd mentioned, on emerging trends in logistics and industrial real estate. So again, thanks for joining us for this Industrial and Logistics Summit. We've got a great group of panelists here to talk about, what they're seeing in the market there and share their insights on what's happening in the Houston market. So I'll introduce myself real quick. My name's Craig Rhodes. I'm the Senior Director of Regional Economic Development at the Greater Houston Partnership. I know I've had a chance to work with many of you over the last dozen years or so in economic development projects across the Houston region. And really, economic development starts with a real estate requirement. Do you have an office, an industrial site, a land site that meets these criteria? If so, move to question 2. If not, thanks for playing. And so, we're, fortunate to have a chance to have worked with many of you, and certainly industrial projects has been one of the staples of the Houston economy for a long, long time. And so just wanted to run through a few stats on kind of the manufacturing and logistics market here in Houston, and then we'll jump in to talk more with our panelists. So obviously Houston's a major manufacturing hub, one of the top manufacturing cities in the U.S. Overall GDP for Houston, over $500 billion, 6,500 different manufacturing establishments, over 230,000 employees in the region that are in the manufacturing workforce. And $85 billion in total goods produced annually in the Houston region. On the logistics side, the same kind of stats, right? We know the Port of Houston is the #1 U.S. port in terms of foreign tonnage, 320 million metric tons of trade go through all of our Houston area seaports, 2 international airports. We're one of only 8 cities in the U.S. that has that. 4,800 transportation and warehousing establishments regionally, a logistics workforce of about 150,000 and over 1,000 different logistics service providers, 3PLs, custom brokers. So, again, just a thriving market here in the Houston region around manufacturing, distribution, and logistics, and continuing to grow. And one of the things we're going to talk about on this panel today is really kind of around sort of the emerging trends. We're living through historic times here. What are some of the emerging trends that we're seeing? What are the effects as we move into a post-COVID world, and what are the effects that COVID has had on the logistics industry and industrial real estate, supply chain shifts, increased demand for cold storage. We're seeing this idea about reshoring. Are we seeing new trends, or are these acceleration of existing trends that are underway? I've heard the phrase, we're moving from a just-in-time model to a just-in-case scenario of where we need to have companies want to have their logistics footprint across the U.S. or around the globe. So some of the emerging trends we're going to try to touch on today with the panel. So real quick, I want to introduce or have our panelists introduce themselves. So we'll start with Maureen Solomon with Watco Companies. Maureen, do you want to tell us a little bit about yourself and maybe an exciting project that you're working on right now?
Excellent. Yeah, I'm Maureen Solomon with Watco Companies. And so as you look at my background, you can see that I am currently sitting at Greensport, which is one of the largest privately owned ports in the nation. So Watco is an operation that includes short line railroads, logistics, trucking, inbound vessels, and barging. So you're thinking, okay, so how does this connect to what we do as far as industrial real estate? A piece of our puzzle is connecting with people that do the investments, assisting with maybe they need a rail logistics site, or they need rail access, or they have a customer that is really worried about their last mile. Our company can work with realtors such as yourselves and help you create an experience for the customer that solves all of their problems. And so involved a lot in transportation. It's very interesting to be a part of railroads, working with the UP and KCS and just a variety of different railroads to get product and goods across the nation. So I look forward to learning more with you and hopefully giving you an insight into what Watco can do to help you with your developments.
Great. Thanks, Maureen, and thanks for joining us today. Next up, we have Walker Barnett with Colliers. Walker, you want to tell us a little bit about yourself?
Thank you, Craig. I'm Walker Barnett. I'm a principal here at Colliers. This is my 19th year in industrial real estate in Houston, all 19 years here at Colliers. When I started here, I was the 14th broker. Now we're over 100 employees. It's been a great time to be in Houston. And in spite of what's happened over the last year, we're kind of in the center of the universe as far as the supply chain shifts that are happening and everything else. And so from manufacturing, from logistics to port related concerns, we're seeing it all right now. So it's a really exciting time to be here in Houston.
Great, thanks, Walker. And then last we have Robert Wheelis with Logistics Property Company. Robert, thanks for joining us. Want to tell us a little bit about yourself?
Sure. Thank you very much. I'm so pleased to be here. I'm the Houston officer for Logistics Property Company. We're a nationwide concern with offices in most of the principal distribution hubs throughout the United States. In Houston, we have 2 industrial parks, just under 100 acres each, one in the southwest and one up by Bush Intercontinental Airport. And we, as Walker mentioned, we are seeing this transformation of the needs of the industrial tenant base changing before our very eyes. So the last few years, we've had to adapt our strategy here in Houston, as in other markets, to accommodate this change. And I look forward to getting into these changes throughout our discussion today. Thank you.
Great. Well, thanks, Robert. So yeah, let's jump into that discussion. And Maureen, maybe I'll start the first question here with you, and then would like to just kind of go around and hear everyone's thoughts. And as Todd mentioned earlier, I'll be keeping an eye on the chat line. So if you're watching and listening in and you have a question you want to ask the group, just put that in the chat, and I'll try to get to those as we go throughout the discussion here. So first question, Maureen, is looking at how would you describe sort of the evolving needs of logistics companies from your perspective right now? What are the changes or evolution of those needs around logistics?
Yeah, it's definitely interesting. You know, you hear people talk about things like the last mile, and the last mile used to be more related to getting to a distribution center. Now the last mile is to someone's doorstep. And so we'll get into more of the Amazon effect a little bit later, but the focus on being as close to the customer and providing a full service from, you know, wherever we're importing from to the user has been a very big focus for my company as far as logistics. We're also seeing differences in methodology. So we're seeing trends, like I think the earlier panel was talking about steel markets. We had a very large decline, of course, as we again live through unprecedented times, as we continue to hear. But now we're seeing imports of steel as the markets continue to pick up. So what does that mean for overall logistics? It means additional warehousing. It means you know, the storage and all of the rail that's related to that type of infrastructure needs. So that's the things that are going on right now. There are also a lot of customers that are advancing ahead of the curve. So they want to import products with the idea that they are continuing to basically do what we're doing. They're betting on the growth of Houston. So we're seeing increases in lumber, we're seeing increases in cementitious products, et cetera, with the idea that they will be continued demand for that type of material in our area. So those are the hot topics that we're working on here at Watco.
Great. Walker, any thoughts about what you're seeing in terms of evolving needs around logistics companies?
We've talked a lot about e-commerce effect, and certainly the biggest boxes you see as you're driving around are the Amazon buildings that have come up. They've leased literally millions of square feet. I think they've either quadrupled or quintupled, or will have quintupled by the end of this year, their footprint in Houston. That was accelerated by COVID and the consumer purchasing patterns that have changed. But another fun part of that's not quite as cool or sexy is some of the supplier related things that are happening. So as an example, we're working with a packaging group that are working with a large online internet fulfillment company that need a place to run a packaging contract that they have. So there are other follow-on effects that are happening from e-commerce. And then, you know, the supply chain disruptions that we're seeing right now from Asia are really, you know, they're an opportunity, but they're delaying some projects that we're working on. As an example, there was a furniture group looking in Houston to build an import related container import facility, substantial in size, and they had to tap the brakes on that because of the supply chain disruptions they're seeing from container flows from China. And so that's getting worked out, but that's on the large scale. And then on the small scale, we're talking with someone who's an interior designer who, you know, does projects for people's homes, and she can't tell them when they're going to have that table or when they're going to have the sofa or the bolt of fabric or whatever it is. So everything from, you know, small things inside the house to, you know, to furniture, to things like that, that's being disrupted. But I really think that's the opportunity in the second half of this year, is as those supply chain kinks are worked out, we should see a pretty good acceleration of deal velocity and closings in the second half of the year.
Great, thanks, Walker. Robert, any more thoughts from you kind of around what you're seeing for evolving needs? I know you've got sites kind of in the airport and then on the southwest side of town. So any interesting thoughts there around kind of what you're seeing with the changes?
Yes, I've got several topics I'd like to touch on. One, to begin with, it's really challenging to plan these parks. Some of developers in Houston and elsewhere make the decision to just build it all out at one time. Our strategy has been to build 1 to 3 buildings and then leave the rest of the park open, because we simply cannot predict what some of the needs are going to be for the more build-to-suit oriented prospects. So parking ties into that. That's one of the most significant changes in the evolving needs of logistics companies. We see, requirements for storage of 150 to 500 trailers for buildings in excess of 500,000 square feet. Certainly, if e-commerce is involved, then you've got auto parking to supplement that. So to support these larger facilities. So it puts a lot of pressure on developers who have to carry land during this period of time while we're waiting for these build-to-suit prospects to appear. One thing that we're seeing evolving is air freight logistics. Up at the airport, we're about 3,000 feet from the cargo terminal at Bush, and we're just seeing a lot of interest in open land for corporate campus settings. So that have as a component heavy trailer parking that tie into the air logistics side of it. So that's a new element that we've not seen before. Certainly the tightening labor market. Some of our prospects are now requiring labor availability studies to be performed to confirm the quality and quantity of labor to support their operations. One new element that's coming out of California or future regulation on carbon emissions. There's a policy in California that warehouses larger than 250,000 square feet by August 22 deploy a net zero emission trucking operation or face mitigation fees. So now you've got Volvo North America involved in evaluating electric or hydrogen fuel trucks. So there's that going on. And then finally, third-party logistics companies now are becoming more and more important. We've got e-commerce retailers turning to 3PLs to help navigate the fulfillment processes that are brought about due to this online purchasing pursuant to COVID-19. So there's a rise in multi-carrier delivery networks trying to consolidate into this highly fragmented freight forwarding market. So those are some changes that we're seeing and we're tracking, and we're trying to develop product that responds to that. So.
No, great insights there. Yeah, I mentioned off the top, that economic development, sort of starts with a real estate requirement. I think, that's question 1A. Question 1B is certainly about talent now and the availability of workforce and labor. We used to see that question, kind of further down the list. And now we're seeing that really right up there at the top, right, is sort of an ongoing concern. So the great thing is about attracting all these new businesses to the market. The challenge is they're competing for a lot of the same workforce. And so understanding, I think the benefit there for Houston is just the sheer size and scope of our labor market, puts us in a really good position, I think, to meet those needs, but that's certainly a part of the analysis. You mentioned something real quick, Robert, there that I wanted to touch on, and then we'll move on maybe to the next question. But you talked about kind of zero carbon emissions. I don't know how much this may impact your area, Maureen, but I'm curious on the building side, Walker, are you seeing some requests around renewables, looking at solar panels or looking at access to renewable power as part of any discussions with companies that are looking to locate in our area?
Yeah, on my side, it is definitely as a topic of conversation. We're very involved in wind energy, partnering with different wind manufacturers, one, bringing in the blades, and two, helping to transport them via rail to their locations. As far as our tenants, we are seeing some interest in that. We're actually in development of a green locomotive for our rail, which will be a very big a benefit to a lot of customers, especially California and the West Coast, where that's becoming more and more of a mandate. Again, it's just like any other time we have an environmental mandate. If the cost is not of interest, people just aren't going to do it. So it's either got to be a regulation or the cost has to be similar, and we're not quite there yet, but it is definitely a focus of some of our tenants.
On the building side, we've had a few people, mainly from the West Coast, who've asked about, can we do solar roofs, that sort of thing. I think that still is fairly nascent, even in California. So that's something that may emerge here, but mandates like zero emissions at these trucking terminals in California, it should, frankly, for Houston and for natural gas. I mean, the CNG technology is there for these trucks if they're willing to make the conversion, and if the market dictates that conversion or the government dictates that conversion. Yeah. So that should be a benefit for us. But one of the things that has come out of this oil and gas latest downturn, as they're continuing to right size their staffing, if you will, is there's a lot of talent that is no longer going to be not a lot, but some talent no longer going to be working in the oil and gas business. And so as we're talking to companies from California and others that are looking at getting away from some of the kind of more onerous regulatory requirements out there and looking to come to Houston or to Texas, the opportunity for them is that we've got a really great engineering talent pool for those guys to develop their businesses and their products here. And they can get a building out of the ground faster and that sort of thing. And if it takes putting solar panels on it, we're happy to do that. We're actually touring a group tomorrow at one of our buildings that are big in the solar panel business. So we're going to see more of it for sure.
I didn't realize that in California, the statistic is 80% of smog forming emissions result from the trucking industry. So I don't know what our figures are here in Houston, but that catches your eye.
For sure. Well, good. Well, we'll move to kind of the next question, and Walker, maybe I'll start this one with you. You touched on this a little bit, and what we're calling kind of the Amazon effect, around sort of e-commerce and the growth in that area. I think we could say that that's one of those trends that was sort of already headed in a positive direction that's only been accelerated through COVID. But just curious kind of what your thoughts are on the effect of the continuing growth around e-commerce and how you see kind of Houston's position going forward in that space, and then we'll just kind of go around and get everybody's thoughts on the Amazon effect.
Sure. Again, the supplier effect is really there. The packaging related to it as they build these large fulfillment centers. It takes cardboard to ship this stuff in boxes, and so that certainly is one thing that we're seeing. And then even less glamorous, but several years ago we did a transaction with the largest towel, like bathing towel, a fulfillment company on Amazon, and their growth trajectory even 3 years ago was like 40-50% per year. It was unbelievable, and they've continued to grow their warehouse footprint here in Houston. And then really part of this is Houston's location as this true third coast solution for container traffic. That really is a positive that we have here, and Maureen knows this well. We are a natural gateway for people to ship containers and get them up into the center of the United States. And so part of that is predictability and knowing when the containers are going to arrive and how they're going to be sent out, and keeping the supply chain in check. And as I mentioned with the furniture group that we toured with back in January or back in the fall, they've got to have that predictability for their end user. It's a direct to consumer model. And so without that predictability, it's difficult, but that will be worked out. And I think Houston will continue to emerge as a major import distribution center, as Walmart showed us 15, 18 years ago with their 4 million feet in Baytown, that we can get containers in here and get them out to the center of the U.S. And certainly as Lowe's and Home Depot and others, Walmart and others, continue to grow their own e-commerce presences, Houston should benefit.
Yeah, I definitely agree. It's interesting. There have been some opportunities recently where the end destination was closer to the Great Lakes than Houston, but we were able to do something as cost effective coming through our ports as they could going up through the East Coast. So we do have some benefits of our cost position. in the Amazon effect, one of the things that I find interesting is what will the impact be of the potential $15 minimum wage? I mean, if you look at what's happening with Amazon, they are a huge employer. You think of it as all online, you push a button and it magically happens. But behind the scenes, the people that were relieved of retail are now working in a warehouse. So Amazon has the benefits of lower overhead and cost. They also have the benefits of a lower tax burden just because they can continue to stack higher versus a retail facility that is, taking up more actual real estate. So there's some interesting things happening there that I'm sure are affecting, Robert and Walker as far as they make a plan for industrial real estate. And then the emulation. So one of the customers I'm working with right now is a lumber retailer, and his shipping was perfectly fine if he had a 2-week delivery, and that a year ago. But now, if he has a 2-week delivery, people will look somewhere else because they're used to immediate delivery. And so building warehouses as close to your end user is the big trend. And I think that's Amazon effect. The way I look at the pandemic is there's 2 types of days, one where a package does arrive and one where it doesn't, because we're all doing that, right? Every single day. And we're spoiled. If it says it's not going to be here to 2 weeks, I just look for another thing, and it's got to be here tomorrow. And so, thus we need more distribution centers. So
I haven't found too many days at my house where a package doesn't arrive. I don't know. Robert, any thoughts from you on the Amazon effect in this whole area of e-commerce?
I sure do. And just to tag on to Maureen's the comments there. I think what we're talking about here is a reduction of risk of an interruption occurring within a diversified carrier network. So if we can agree that the Amazon effect is the idea of one entity controlling all movement of goods to a point of delivery or to the end consumer, we find that shippers, hence those are our customers here in the warehouse business, are updating their supply chain strategies to evolve into a single end-to-end provider. And we're seeing it at all levels. For example, Merck is evolving from an exclusively ocean transport to a combination of port terminal services, customs brokerage, warehousing, and trucking. I'm not telling you anything you don't already know. How about Amazon? They just added 10 or 11 Boeing 767s to their existing fleet of over 80 to expand their air freight services to complement the ground, freight services. So the question gets back to our customer base, our tenant base that Walker deals with day in and day out. Does the customer utilize one large distribution center, or do they adopt the Amazon model that incorporates large multi-story fulfillment centers that are then supported by smaller sort centers or even more last mile centers? So like in Amazon, in the last 36 months, I think that they built at least 15 to 20 buildings to service this MSA. So it's pretty incredible. One last example, which I find intriguing, some of my colleagues teased me. I was just for fun creating, drone pads, future drone pads within our parks. So I was the brunt of a lot of teasing for that. But now I see UPS, now that 5G networks are being installed in our population centers, UPS has teamed up with Verizon subsidiary Skyward. And they're delivering now retail products in Florida via multiple drones that fly simultaneously from central locations. To scale this kind of operation, you need 5G, but these vehicles now with the packages and multiple drones are driving into central neighborhoods, and these packages are now being delivered by air. So it just as a test. We may be seeing more of that in the future. Yep.
Oh, great point. I remember seeing those sort of beehive things online of the drones sort of leaving out and going to their destinations, and
Yes.
seem pretty far-fetched, but it may be much closer than we think. We did have a couple of questions that came in the chat, so I was going to try to touch on a couple of those before we move to our next discussion item. One of those, which I'm sure we all expected, is around our Texas electric grid and the challenges that we all experience. Hopefully, we're all thawing out and getting repairs done as needed. But just curious what your thoughts are in terms of with that challenge, how that might affect companies looking into Houston, looking into our region on the industrial side, if that has any potential impact, future impact for companies looking in our area.
I think if you got to be in Houston, you got to be in Houston. And it's really interesting. I had a friend that called from Washington last week to kind of check in, and he said, "How are your kids handling this?" And I've got 15-year-old twin daughters. I said, "This was nothing. They've been through 3 hurricanes. They've been through Harvey. They've been through this quarantine. I mean, this was just like, it's just kind of what happens. They handled it well. I mean, as long as their phones were plugged in the car." But we've gotten through all this, and it comes back to sort of the basic, up by the bootstrap mentality that Houston's always had, and the hard work ethic and everything else, and people that want to be here like that can-do attitude, and I think they get that, and yes, I mean, California's prettier and that sort of thing, but it's just an easier place to do business, and it's got a great, well-trained workforce. We've got good people, we've got good food, we've got everything you want in a big city. Yes, it floods here. We still got to figure out how to keep the lights on when it gets cold, but I'm pretty sure that they're not going to let that one happen again, because that was just too bad. But I don't think it scares people away. I think it just makes us that much more of a long-term, more secure place to do business for people.
But I think on our side, tenants are looking at redundancy, generation, piping, et cetera, et cetera. Some of the things that we likely should have looked at anyway, but it's just an additional consideration. Could it impact some of the build cost if we put in additional generation and backup systems? Yes, but again, for the hurricanes, we probably, they would have liked that anyway. So I think it doesn't change too much as far as what we're seeing.
I think to tag on to both of those comments there, redundancy in power is something that we're focusing on for our industrial parks. Just the same source from CenterPoint, but from 2 different directions in the event that one line is somehow compromised. There's no defense against a total loss of power. And that's not what really we're focusing here. I just think we're discussing 2 alternate routes to bring power to a park in the event that one is compromised. So that's our focus. I believe, like Walker, this is kind of a black swan event. I don't think it's going to happen again. I think it's fixable, and I don't believe that it was just an inconvenience for us for a period of time.
I appreciate those comments. I agree. I think this is something we'll get fixed at the Texas legislature, I would think, in the next 90 days or so. So, and also interesting, just from a Houston perspective, that this was a Texas-wide issue, right? So unlike a hurricane that might have been a Gulf Coast where a company might have said, well, maybe we should look at Dallas or maybe we should look in Austin, San Antonio. This was a statewide. So I don't think it has some sort of specific impact on our area like we would see maybe with a storm. One other question that came in the chat was kind of around a forecast on physical innovation and biomanufacturing facilities in the Houston area. Any comments around maybe what you're seeing? I think physical innovation maybe being around innovations with the actual space itself, or innovative innovation kind of incubator type interest from companies, or anything around biomanufacturing. Any thoughts on that comment? Question.
I have just the pleasure of doing a tour through the medical center pre-COVID of some of their existing facilities there, where they encourage the emerging companies sponsored by some of the larger medical companies, Johnson & Johnson, for example, where these incubator companies, entities can be formed and get their product studied and evaluated and brought to market. And since that time, there are now 4 major projects going on along Holcomb Boulevard right now to focus on just that kind of thing. And that's not to mention the alliance between Rice University and the medical center. So there's a lot of that, those facilities now being planned and built and right at our doorstep.
Yeah, we're not seeing any large scale biomanufacturing facilities per se here in Houston, but I agree with Bobby that we are a very important incubator for that technology with what happens at MD Anderson and the Texas Medical Center, and tying in the engineering mindset here, both from NASA and from the oil and gas industry. Hopefully that's something that we'll see more of, particularly a lot of those companies are located up in New Jersey and out in California. So I would hope that we'll see more of those in the future.
Absolutely. All right. So next question we have is kind of the growth that we've seen around we term them massive scale projects, but these larger size facilities, maybe going from the 250 to 300,000 square foot type operations to looking at 800,000 to $1 million, more what you have we've traditionally seen in that kind of Dallas-Fort Worth submarket. So thoughts on or your perspectives on what's driving this new sort of large scale projects for the Houston MSA? Somebody want to start with that one?
Sure, I'm happy to start. The e-commerce, certainly, I mean, everyone's going to say e-commerce, I think, on the panel. It's been the biggest consumer of space over the last few years. E-commerce sales have grown to 2018 to 2019 from 600 billion to 800 billion and projected much higher for this year. So the typical e-commerce footprint has ranged in size from 500,000 feet to 1 million feet or over 1 million feet, but we can count at least 7 of these speculative buildings in the size range. It's interesting though to watch several of them, of course, at least, but many of the e-commerce concerns coming to Houston have elected to self-perform and then go through the transaction of the sale leaseback rather than allow the speculative developer to capture that upside. So part of my thought process is that I'd rather approach the e-commerce market with smaller buildings, but have land available to build a suit, a specific requirement. Certainly, we talked about the trailer issue and the parking issue. One last point before I hand it over is that the location of Houston relative to anywhere else in the country is unique. We have what we've just come to an agreement with 4 major shipping lines from China into the port of Houston. From Houston, you can access almost 50% of the population of Texas within a 4.5-hour drive. So within 11 hours, a driver can travel from all points, across Central Texas and get back in time for dinner. So that's a real strong attraction to retailers. Some of the San Antonio developers I've spoken to talk about how West Houston is capturing much of that business from the San Antonio market because they can just access so much more of Texas from our location. So it's a really interesting, great location to be in the future, I think.
Some of the largest scale industrial parks, frankly, in the world are located here in Houston. If you look at TGS's Cedarport, if you look at Generation Park, if you look at these guys have taken down 5, 10, 15,000 acres of land that has rail infrastructure, has water infrastructure, has proximity to the port, has easy access to the interstate. So, you know, those are truly large scale. It's harder and harder for industrial developers to go out and get the mandate to take down 300 acres to build a massive scale park. But you know, some people are still doing it with what Stream has done out in West Houston at Empire West, is really playing off of more regional distribution, so that they're on the west side of Houston. They can easily access San Antonio and Austin. It's difficult to build buildings in Austin, and I know that they've seen some requirements out there that are related to the plant. As an example, in Austin, for a supplier to build a 300 or 600,000 foot building in Austin is much more difficult than it is to find something in West Houston. Plus, it also ties that facility back closer to the port, which may be related. We actually had at one point the 1 million foot building out in Baytown. We had a proposal for a automotive components. Can't say what it was, but an automotive components concern that was they're going to be supplying a large electric car manufacturer in Central Texas. And that probably is not going to happen. It's going to go to Dallas instead. But that's not just e-commerce. That's something other than e-commerce. But you know, population growth, it's back to the fundamentals. Population growth in the area are driving the need for larger scale distribution buildings. I know that Justin and Jeff touched on that in the first session this morning.
And I think it ties back to something that one of you said earlier about the labor market too. We have a quantity of skilled and semi-skilled labor that is coming off of potentially from oil and gas jobs that could be very transferable into a warehouse management or crane handling, et cetera, to manage these larger facilities for this type of warehousing. So I think it all can come together to be a very big boon for Houston, and also help us balance out our economy to a more, you can call it, like you said, online but it's still retail. It's still consumer goods. And so I think it helps us, during these different types of downturns and strange turns that we're going through right now.
You know, and contrary to the recent February article in the Wall Street Journal, let's talk about what is not driving these massive scale projects. Energy is not driving them at all. When you examine the top 10 sectors representing the current active tenant base in the market, energy is number 10. So our occupancies tend to be driven more by consumer goods than energy related products.
Great points there. And certainly I think when you look at that long-term projection around population growth, there doesn't appear to be any slowdown in that for our region. And I think that bodes well for those consumer products. And the market has grown to a size where you're not able to just serve this market from a central location, maybe in Dallas Fort Worth area or something. You really need to have a significant presence in the Houston region, serving the Houston region. And then to your point, Robert, about picking up, a larger swath of Central and South Texas, as well as some of our neighboring states out of Houston. So, Maureen, maybe I'll start this last question with you, and then we'll have some time maybe for some final thoughts, and then any other questions that folks want to pose in the chat. But I know we've talked a lot about kind of the last mile delivery options, but specifically around cold storage or fresh products. Obviously, we saw a huge run on with our grocery store chains and what's happened in COVID, and even just what happened last week with the winter weather. So are you seeing any increase in activity around cold storage, fresh products, and then obviously what's that leading to from an industrial real estate perspective?
Well, it's interesting because I'm going first on something that I really don't have a lot of expertise, but I did do some research on this. And one of the things I read is that the cold storage infrastructure, that most of the buildings are 40 years old. And so you think about not just the problems that you have with old technology, but the advances that have happened. I mean, Robert talked earlier about drones and things like that. I think that's where we're headed, but I'll turn it over to Robert and Walker, who have more exposure to that market.
Yeah, actually sold a 40-year-old cold storage building in Houston last June that was owned by an investor group from Dallas. They bought it as part of a larger project. One building was about 40, almost 50 years old now. One was 30 years old. But state-of-the-art technology on the inside, just didn't have the big clear heights and that sort of thing. But the issue that we found in marketing that building is that it was outside of the heavyweight corridor where overloaded or overweight containers, it was just too far northwest, frankly. We were 36 miles from the port. And so in that vein, we were fortunate enough to sell that to a group that wanted to in-house their food distribution again. But in that vein, I work very closely with our food services team out of Atlanta, Chris Cummings and Turner and Sam and their team. We're working with a developer in Houston called Boomerang that are developing a building called Houston Cold Port, which will be a true state-of-the-art 285,000 foot freezer building. With these buildings, it all comes down to how many pallets can you fit in there and move around as efficiently as possible. And so all of the engineering of this building, everything else has been driven to that base economic measure that these both end users and third-party logistics companies work with. And so we're pretty much every week on the phone with corporate level executives at the major national and international third-party logistics companies to talk about this building and their need to be in Houston. So that building is in the heavyweight corridor. It's in near Northeast Houston, and we're going to build that. We'll start that this year. And then out in Cedarport, out in Chambers County, there are 4 freezer related deals, if you will, in the market over 600,000 square feet. Those are large scale freezer buildings. These are mostly generated around or built around the protein import and some protein export. But again, they have that close proximity out there to the container terminals so that you're not running into the fine issues. These frozen proteins weigh a lot. They have water in them. And so they weigh more than the typical containers are allowed to weigh. But it's an exciting space. We're still trying to understand what the true demand drivers are. But there is a lot of interest out there in the market right now.
That's really interesting, Walker. I've got just a few things to tack on to your comments. Very interesting stuff. First, on cold storage, one trend that I'm seeing in evaluating is this notion of a decentralized food supply. And certainly the growth in this last mile delivery is very important to that. One element of that is the indoor agricultural segment, which supports a more stabilized, decentralized food supply chain. There's $1 billion of equity has been invested in the space just since August. The focus is on leafy greens and lettuce production, which is currently grown primarily in California and Arizona. But year-round harvest, close proximity to populations where it's consumed and less water and soil are needed. One of the coolest deals that I have seen, and Walker, you're aware of this, is Jackson Shaw's deal up at Park Air 59. I've got the stats, but I think it's roughly 80,000 square feet for hydroponic lettuce production. And goodness gracious, the TI is staggering, but they're associated with various other food-related distributors, and so it was economic for them to locate there. They're not alone in different parts of the country. Heck, in Kentucky, this App Harvest group has got almost 3 million square feet of indoor production, supplying 70% of the population within a one-day drive. Gotham Green supplies 5 states. They've got 500,000 square feet of indoor space. So we may see more of that happening, but that's my comment onto your cold storage. The last mile delivery option idea is one thing we're seeing. We talked about Houston. It's with 9,500 square miles, almost 10,000 square miles of our MSA. With about 15 million consumers within a 4.5 hour drive. we're talking now about bundled deliveries, and retail storefronts were just never designed to operate like fulfillment locations. And so COVID-19 raised the issue of inventory visibility versus consumer delivery. The idea of one order, one delivery, it just doesn't work. So bundled deliveries, pickup density now is now a logistics topic that our customers are embracing. So
HEB wants those Instacart guys out of their stores. It's impacting the shopper experience
yes.
market and the HEB stores. So they and others have been in the market looking for true fulfillment centers where they, like you said, where they can bundle this stuff. So that should be a continuing trend there, for sure.
That's going to impact, how we design and build buildings and how we fill those, and how you, Walker, fill up our buildings, basically. So we have to keep that all in mind, who the end customer is and who we're building for.
Right.
Yeah.
Yeah, no, good points. And to your point earlier about what does that do to your footprint in terms of parking, if it turns into there's a retail component to that if you've got customers coming in. So that's an interesting piece of that last mile equation. So we've got a few minutes left. So maybe we'll go around and just get any final thoughts from everybody. Something we haven't touched on. I know one of the kind of emerging trends I mentioned off the top was around reshoring. So I'm not sure if anybody is seeing interest or activity from companies in this reshoring space. That kind of ties into that comment I made earlier about this sort of, we went from a just-in-time kind of model to a just-in-case scenario. I need to have, a backup to a backup, scenario. And so that might be a topic if you want to touch on in your final comments. We also had a question about COVID-19 vaccines and logistics and delivery of that. But maybe just to broaden that, if you've seen any interest around PPE in general for any space in the market. I know there's been a lot of interest. Have there been any real tangible projects that have come to fruition? So
yes,
things if you want to touch on in your kind of last remarks.
There have been several buildings that have been leased or bought by PPE manufacturers, assemblers, that sort of thing, mainly in North Houston. There's a very large PPE purchase requirement that is active in the Southeast right now, which will help with our absorption, frankly, to get some of the bigger buildings off the market. We've not seen any requirements that I'm aware of as far as COVID vaccine distribution. Some of those require these really deep freezers and that sort of thing. They're just too expensive, and you can't build those in the shorter period of time. But I think as the Johnson & Johnson vaccine is less temperature sensitive than some of the others. But I don't know that that's going to have an impact. But one of the other things that has driven re-onshoring is this Buy America First program from the government. And so you do have some U.S.-based manufacturers that had manufacturing in Indonesia and other places in Southeast Asia that are re-onshoring to the U.S. And then with the furniture groups that we've talked about, they're actually looking at onshoring some of that furniture manufacturing, not necessarily to the U.S., but to Mexico, so they can get away from the delays in container shipping and congested ports in Asia and be able to use the rail that comes out of Mexico. And where we've got to figure that out is that's all Kansas City Southern Rail that comes out of Mexico, and it doesn't go to industrial warehouse parks right now. We can build that if the demand is there. But we're in a good place in that we've got the rail lines from Mexico, we've got the shipping lines from Asia, we've got the airlines coming into the cargo terminals up at Intercontinental. So again, Houston is really well positioned to answer pretty much all of this to help the country get back on its feet.
Just to tack on to Walker's comment there, I returned to cargo transportation. And we're warehouse people, so why should we be concerned about getting the cargo before it arrives at our warehouse? Well, we have to take that into consideration. Right now, with the port congestion on the West Coast and elsewhere, the demand for cargo transportation exceeds supply. Ocean rates between China and East Asia to North America are up like 200%. Air rates are up 135%. So the expeditious delivery of product to the consumer now is being delayed, and so that's impacting the freight forwarders. Like for example, Expeditors, the 3PL, moved more freight in the fourth quarter of last year than in their entire, than ever before in their history. So, ocean rates and port congestion will just remain elevated until the demand for Asian exports subsides, and that's not going to happen anytime soon.
Yeah, I definitely would agree. I mean, the congestion on the West Coast has been impacting all of our activities. There's also been a little bit of a move with some of the slowdowns in India and China, where some things that would generally come in bulk are coming in containers versus bulk, just because the production is at a smaller capacity. So managing that. Walker, you touched on something interesting about the back and forth to Mexico. So right now, fuel goes towards Mexico, and then goods and services come back. So it's very interesting to see how that transport, and you're right, there is a need for logistics facilities related to what used to be the maquiladoras or wherever they're manufacturing now, as that becomes semi-onshore, at least in the continent. So that'll be very interesting to see.
Maureen, also, I had the pleasure of driving almost to the Mexican border down the Benson, I-69, I-59 this past weekend. It's all under construction. So when that opens up, that's going to really encourage more trucking activity and more cross-border transactions, I think.
I think so too.
Well, great thoughts, everyone. I guess I'll do one last pitch. If somebody's got a burning question they want to throw into the chat, we can touch on that. I know we've got maybe a minute or so left here. But let me just say a big thank you to our panelists, to Walker and Robert and Maureen for taking time to visit with us today, share their thoughts and insights on what's happening in the Houston market and what's happening specifically around sort of these emerging trends in the logistics and the industrial real estate. I think to Walker's point, and I think everybody mentioned this, right? It's I think really an exciting time for Houston. I think because of the assets we have in place and the positioning and the central location and all those great benefits that we're really in a great position to come out of in 2021, I guess, in a really strong position of growth moving forward. So with that, I think we will wrap up this panel, and Todd, I will hand it back over to you.
Thank you, Craig.
Thanks.
Kudos to the person who put virtual round of applause in the chat room. I always wave now. Does anybody else wave at the end of Zoom calls? It's a little bizarre, but what are you going to do? Would I wave in person? I don't know. Fist bump. Okay. Thank you, everybody. Fantastic event. I got to pitch our upcoming events. I already pitched awards. Don't forget about that. Watch your email for that. Industrial Summit on Thursday for Dallas. And we got this great event in the Rio Grande Valley. I think we're going to do this event every year for like 10 years because there's a lot going on in terms of onshoring, nearshoring, reshoring. You all brought it up. It's great. And then we have a net lease event coming up for that, is going to cover not just Texas, but probably the whole nation. So that's my screen share for the day. Thank you, everybody. This will be on YouTube. If you are one of our speakers, you can now tell your kids you're going to be a YouTuber. And so don't forget to go there, watch that, hit like and subscribe, because apparently anybody over the age of 40 doesn't know there's a subscribe button on YouTube. So we appreciate when you do that. Thank you, everybody. Have a wonderful afternoon. I hope you all stayed healthy and warm and that you enjoy the sunshine, because up here in Minnesota, it's still frigidly cold. Thank you.
Thanks.